Good evening, all. It is very pleasant evening for a pleasant topic. The topic is so important that I audible clearly now. Yeah. So this is an important occasion for all of us because we have two stalwarts of SIRC today amongst us. One, Mr. Additionally Venkateshwar Rao, past chairman of the SIRC, and also of the past term and my colleague, and the present term past chairman of the SIRC, Mr. K. Gaman George. And I am also having a good company of another regional council member, Sri Sundarajan sir. And very specially, I have my own man, Mr. Gururaj Acharya, as a speaker from my own town. So before I enter into that, I just make one statement. I have taken the pleasure of introducing Mr. Additionally Venkateshwara for myself, but I have given the pleasure of introducing the speaker to Sundarajan sir, because I, being teacher of one-time teacher of Gururaj Acharya, would like to make one statement today that in Shakespeare's words, it is always boon to have an overachieved son, but it is always a curse to have an overachieved father. This is the statement of Shakespeare, William Shakespeare. I would change it now. It's always boon to have an overachieved student of mine from whom I am learning today, and I am proud of. So I have no curses. I am all proud for myself to have an overachieved student of mine from my place, Mr. Gururaj Acharya. And I would request today, as you all know, the topic is the amendments for audit of 2021. This is very vital because audits have already.
Selva, can you mute others? There is some background disturbance. Other than Pandey sir, can you mute others for the time being, Selva?
Yes, sir, it's problem with this iPad little bit. Okay. Good, sir. Yes.
Please continue, sir. Pandey sir, sorry. There was some disturbance. I was trying to solve it.
There is connectivity issue, is it?
Seems, sir, that is the reason, sir. So
yeah. I'll not take much time. I wish to introduce Additionally Venkateshwar Rao Garu as a practicing chartered accountant from Hyderabad, and he was part chairman of the SIRC in the last term. I will take some time to introduce him. He was chairman during the 1890. It was the year in which he was the chairman, and born in 62 from a humble agriculture family in Ugatur village and Mandal, Krishna district, AP. He has risen to the position with his sheer dedication, be it in education, professional service, and service to the society through various other forums. An affable personality, CA Additionally Venkateshwar did his schooling in his native place in Guntur, and is a fellow member of the ICAI and practicing in Hyderabad. He entered into the Active Institute's activities in 2007 and been elected to the managing committee of the Hyderabad branch of SIRC of ICAI. During his two terms between 2007 and 13, he served as secretary, vice chairman, and chairman of Hyderabad branch of SIRC of ICAI. And to his credit, in ICAI, he was at the helm of the affairs when the Hyderabad branch of SIRC of ICAI celebrated its golden jubilee of its formation in the year 2011-12, and also received the best branch award among a large category of branches from SIRC of ICAI. Presently, as chairman of SIRC of this he's leading the SIRC when it is to celebrate the Golden Jubilee conference on 31st August and 1st September. So two Golden Jubilees he has seen, both of Hyderabad branch and of SIRC. At SIRC he has served as SIRC CASA chairman, treasurer, secretary, vice chairman, and also as chairman. And he is a very efficient organizer of various programs. And we have amidst us Additional Venkateshwara Garu to inaugurate this evening's program. I think because of the connectivity problem is not seen, but we can hear it. Over to Additional Venkateshwara sir. Before that, I welcome all of you, Gururaj, Acharya, all the Additional Venkateshwara Garu, Jaman K. George, Sundarajan sir, and all the delegates, all the senior delegates. This program is very, very important. I think Jaman K. George would be a better person than me to give hints about the importance of the compliances and the reporting using these new compliances, because he has been very critical of so many non-compliances all along. That is what is he has proved himself right by seeing the number of non-compliance complaints that have come to the disciplinary committee levels. So that is the reason why this program has become very, very important. And the meticulous preparation of Mr. Gururaj Acharya and his presentation, in my opinion, will definitely help the small and medium practitioners to a great extent. So, with this, I request Mr. Additional Venkateshwara to give his opening remarks for the day. Over to Additional.
Sri CAS Pannaraj Garu, Secretary, SIRC, if I say, my good friend. CA Jaman K. George, Past Chairman of SIRC, if I say, my good friend. CA R. Sundaraj Garu, Regional Post Member Garu, my good friend. And CA Gururaj Acharya Garu, excellent speaker on the subject, and he is always available whenever we want, and eminent speaker. And my dear professional colleagues, good evening, all of you. Friends, particularly the chapter they have chosen is very, very useful for the current scenario, because after introduction of faceless assessment, now there is no need to go to anywhere, to any income tax, unless otherwise you are professionally equipped, particularly specialized in this all subjects, then only you will be able to file your or do audit of your clients. I recognize the presence of Srimati Revati Ranganandan. Good evening. Friends, today updation of knowledge is must. Particularly this in COVID scenario, we are unable to meet personally. Even though we have a lot of love and affection, we are not able to meet our own kith and kin. The scenario has come to stage, even if we lose our own family, even government is not allowing us to go and see them. That is the scenario. So in this situation, we need to do audit only through technology. So unless otherwise we have updated our knowledge with technology, we can't do even audit. So this is the right time. When I was doing my articleship, I remember when we used to do additions, we used to use adding machine. There was no even calculator at that time. We used to use adding machine. Today, you see the scenario. Every field, even telephone, we used to ring each number. Today, everything is digitalized. So unless otherwise we update our knowledge, particularly in our profession, we cannot compete with we cannot even fulfill our profession. We cannot fulfill the criteria of our competitive world. So organizers have chosen a right topic, important amendments for audit. So I convey my sincere thanks to the organizers for giving me this opportunity, and very nice to see you all. You take care of your health and your family, and please safe, stay and healthy. Thank you all.
Thank you very much, Smriti Garu, for your opening remarks. Now we have with us another expert.
Sir, it's saying the
Seems to be
screen.
some
Committee matters
Sir, can be
and
closed.
our part chairman, Jaman K. George, whom I wish Revati Madam to join. Revati,
Sir, you are not clear. I think next is to introduce the speaker, right? Which Sundarajan sir is supposed to do. Am I right?
introduce you, sir. Introduce you by Revati Madam.
No. For me, no. I'm not the speaker. I'm just in light.
I
I will
know.
say that
I know.
giving.
Yeah. Briefly, you please, Revati Madam, please briefly you can introduce Jaman first, Jaman K. George first, and then I'll request Sundarajan sir to speak, to introduce the speaker, and he will take over. The moderator for the day is Mr. Jaman K. George. Yes, we should respect him.
Ma'am, you're muted. Sorry. Unmuted.
Yeah. Good evening, friends. Good evening to the chairman in absentia, secretary, CA Sundarajan, my colleague, Adismali Garu, former past chairman, and CA K. Gururaj Acharya, who I'm eagerly waiting to hear. It gives me great pleasure to introduce my own professional, council colleague, CA Jamon George. I don't think that he needs any introduction. He's, I think, I would say, on par with CA Gururaj as far as company law matters are concerned, and he's a very prolific speaker. And I would say, I'm just speaking extempore based on what I know of him through my interactions, and you can always expect his talks to be laced with an undercurrent of humor, and hence it makes it all the more interesting to listen to him talk. So I don't think I need to say any further words about our own friend CA Jamon George. I will hand it over back to our secretary. I would just like to say the Gururaj Acharya's talk is something which I really especially enjoy. And sir, there's one thing which you spoke sometime back in one of the meetings about the definition of a relative, where you said upar niche aage piche, you'll never forget who a relative is after that. So waiting eagerly to hear you speak, sir. Over to the secretary.
Yes, thank you, madam. Now over to before I request Sundarajan sir to introduce the speaker. I wish to inform the audience that Mr. Jaman K. George will be walking through the subject along with Mr. Gururaj Acharya as a moderator or interactive, to make it more interactive and more lively, because it is a 3-hour session, and there should not be any monotony on this watching this program, but it should be very well consumed because it's very, very important topic. So now I request our Sundarajan sir to introduce the speaker.
Sir, you're muted.
Respected Secretary Sir, today's Chairman in absentia of the Jalvadi Sir. So, respected past Chairman, Joman Sir, respected past Chairman Adisumali Sir, respected Gururaj Sir, Speaker of the Day, respected Revati Madam, our Council colleague, and the persons attending the program and the professionals attending the program. Namaskaram to you all. I've been given the pleasant job of introducing Gururaj sir. First of all, I would like to say that he has come from a temple town, Udupi, brought up in the iron city Bellary, and is now well settled in the knowledge city of Bangalore. I think you have not forgotten your way from where you have come. I think that is appreciable, sir. Thank you. You have come from temple town Udupi, iron city Bellary, and knowledge city Bangalore. Your introduction starts from there, sir. I'll give you your qualifications, sir. You are a rank holder right from your college days. You have done BCom with first rank, and CA inter 21st rank, final 10th rank, ICAI inter first rank, and final 3rd rank. Double qualification is there for you, sir. And is a member of the Bangalore Financial Reporting Review Group, formulated under Financial Reporting Review Board of ICAI, New Delhi. Was a director on the board of directors of State Bank of Mysore. Was a member of the Karnataka State Level Audit Advisory Board. Was a co-opted member of Expert Advisory Committee and Committee on Accounting Standards for Local Bodies by ICAI. And he has authored a book titled Internal Financial Control Practical Handbook on Audit Report, What Can Go Wrong? That's been published by Karnataka State Chartered Accountants Association, and he is a resource person in accounting standards, standards on auditing, Companies Act, LLP, corporate finance and financial analysis, corporate tax and tax audit. So this is a small introduction what we have given here, but the entire society knows you as Gururaj Acharya. It's an expert in this field. So that's what I would like to say, sir. Thank you for the opportunity. Thank you, sir. Floor is yours, sir.
Thank you so much. I mean, I'm so honored to be in the midst of very knowledgeable and good administrators, I should say. SIRC is in very safe hands at this point in time, and it has always been lucky to have very good leaders. So today, I would like to bow my pranams to all my gurus, out of which, as Mr. Pannaraj was talking about, he would not like to introduce me because we are related parties in that sense. There is a section 188 connection between me and Pannaraj sir in that sense. So Soundarajan sir, you read that I have got some few ranks, and the credit for all those ranks actually should go to Pannaraj and his family, because he and his brother Dr. Jayanna were the ones who were not only teaching me but constantly inspiring me. The quality of a good guru is not only to teach but to inspire. And the best part about these two people is that, like what he said, they were always proud when their students overachieved, and sometimes, I mean, in his own words, I would like to say, they would like to see the growth of their students beyond them. I think he is a true guru. In that sense, my salutations to Pannaraj and Dr. Jayanna on this particular day. Immediately, I would like to thank Revati Madam to be in our midst today, because Section 149 of the Companies Act talks about every company should have one women director. So today, in that sense, we have one lady in the panel. Madam, I would like to say always, if I may ask you, what is the reason for a women director to be there in the company? Let me answer on your behalf. It is not to do a favor to the women. It is not to do a favor to the women, but the other way around. In fact, the company will be bereft of a particular ideology or a particular aspect if only the gentlemen sit in a board meeting. When a lady, and for that matter, I always say there should be one person who is about 18 years or 15 to 18 years also in the board, who can give an altogether different thinking to the board. We will always be taking things for granted in a particular way. But when our children ask why not, when we will be saying that that is the way it is done, the moment they say why it is done the way it is done, we probably sometimes don't have an answer. So it is the women and probably a person who is around 15 years who can probably give a different thinking altogether. So that way, thank you, madam, for being there. And of course, I should have started with the Venkateshwar Rao Garu, because when Lord Srinivasa and Lord Venkatesha is there, I think we don't have, I mean, there cannot be any adachane in that sense. There cannot be any vigna in that sense. So thanks, sir, for being the chief guest today. In absentia, of course, I'll have to thank the speaker, thank the chairman Jalapati Garu for bringing me virtually today from Bangalore to Chennai, and from there beaming all over South India. Having said that, I have the good company of Jamon K. George today. In fact, in the morning, I texted the chairman saying that I would like to have somebody along with me on the screen. I never expected it would be a person of Jamon K. George stature. Thank you so much for being today with me and moderating the session. So I would like to now recognize the presence of about 800 participants I have told today. I want their active participation, because this is not a subject which can be one way. I'm sure you will have a lot of questions. Please post your questions. We grow only through questions. We will try, of course, between me and Jamon, and of course Panaraj sir and Soundararajan and Revati Garu, we will try to answer all your questions today. So whatever questions you have, please post it in the Q&A box, and I would request Jamon George to read out the questions at the appropriate question stations. Every half an hour I will come to a station and request you to read out the questions. So those questions we will definitely answer. So that is our promise to you. Coming to the topic for the day, I'm going to talk on the important amendments for audit, particularly corporate audits. I will also touch upon the non-company audits, what are the changes, because there has been a couple of changes with respect to non-company audits. So I will be touching upon accounting standards, standards on auditing. Let me tell you the good news. The good news is, for the financial year 2021, there is not much of a change. There is not much of a change. I mean, somebody was asking me, what are you going to talk for 3 hours on a topic where there is no big change? I said, while I will be probably brushing the dust accumulated, which was required for doing the audit, whatever we did for 1920 more or less continues for 2021. But there have been a lot of changes for the next year, which is very relevant when we are doing the audit right away, so that we can advise the client when we meet them to take care of the things to come in the next year. That apart, we had a Companies Amendment Act 2020, which was passed, which has a bearing more so in relation to corporate social responsibility, CSR responsibility. Then there have been this Schedule 3 and CARO confusion, whether it is applicable for 2021. At the beginning itself, let me tell you that it is not. It is not applicable for, although the notification came on 24th of March 21 saying that it is effective with the immediate effect. We have to take it as though it is effective for financial statements commencing from 1/4/2021. So therefore, the new Schedule 3 and CARO, although I will be touching upon through my presentation, it will not be applicable for financial year 2021. But the most important take-home point to be noted is that when you are doing it for the next year, when it is applicable for 21-22, 2021 will be a previous comparative figure. So whatever the required changes for next year, if you are well prepared about that in the current year itself, when you are doing that, will not only act as a dry run, it will also act as the comparative when you are doing the next year. Now also, along with Schedule 3, CARO 2020, which was initially applicable for 1920 itself, got postponed. They said then it will be applicable for 2021. That also further got postponed. Now CARO 2020, which is again a 20-point program. Right now, what we are required to follow for financial year 2021 is CARO 2016, which is a 16-point program. Jamanji, it will be very interesting to note that the CARO years are very interesting. CARO 16 has got 16 points. CARO 2020 has got 20 points. So in that sense, the CARO 2020, which is a 20-point program, if you may call, will be applicable from the next, from the current year 21-22. That is when we are doing the audit of that for the next year. Although I will be touching upon CARO 2020 vis-a-vis CARO 2016. How is CARO 2000? What is CARO 2016? All of us are aware. But what are the changes that will come through in CARO 2020 is also what we go to see. Then we will also see some of the important announcements with respect to accounts and audit coming out from ICAI, along with changes in MSME reporting and the reporting on account of the COVID relaxations given by Reserve Bank of India? How do you deal with those relaxations? So that is the menu for the day. But before I go further, I would request Mr. Jaman K. George to give his initial talk on the subject.
Thank you very much, sir. Good evening to all of you. The respected Secretary of SIRC, C.A. Panraj, my council colleagues, learned colleagues, Revati ma'am, Sundarajan sir, the chief guest, and I always used to call him my chairman, 1819 chairman, Additionally Venkatesh Rao, with whom I had the distinct privilege of working in 2 terms in SIRC. We had a great time interacting, traveling together, and holding programs. So nice that he has come back to SIRC to be the chief guest and deliver a very brief but yet focused address, setting the mood for this evening program. The very, very learned speaker, Gururaj Acharya. I always say that he's Guru, he's Raja, he's Acharya. But then we have the Guru of Guru, Panraj sir also. Panraj sir who said that, it's very nice to see the disciple overachieving out of his modesty. And most importantly, as the speaker mentioned, 800 plus participants, members, and probably students also attending this evening program on a very important topic of Company Audit 2021, what is relevant as we embark on this new audit season. Some of us have completed the listed company audits, bank audits have been over, and for most of us, for medium-sized, small and medium-sized firms, SMPs as we call, most of the audits are waiting to be done. Of course, technology has to be leveraged upon, some of them still remotely only possible. But then to understand the purpose, the very objective of an audit, reiterate a little bit on the basics, on a recap on the basics is very important. So I think this session is all about that. So sir has already started off. I don't want to go for a long thing. This morning, Jalapati, the chairman, who is not with, he is attending another program, just sent a message saying that Gururaj sir wants somebody to be on screen with the video on to give company and to make this probably not a very long session, 5:30 already. So maybe 2 hours plus 2.5 hours. But I've just, sir has shared the presentation. It is exhaustive to give company and make it a little interactive for the members to avoid a very lengthy monologue. But when sir speaks, it never feels like a monologue, because it brings a lot of practical examples, which comes from his unparalleled, rich and varied experience in the corporate, real corporate world of the country, not sitting in Bangalore. He's a consultant to many of the large corporates I know. So coming back to the audit, there are 4 things I think which are very important. When I was teaching 20 long years, I used to ask my students, what is the end product of an audit? And a student would say that it is an auditor's report. But actually it is an opinion on financial information, which is conveyed through the medium of an auditor's report. Added to the concept of that, we have the additional requirements like CARO, which is getting amended, but sir has already mentioned that CARO 2020 is not applicable for the financial year 2021. So therefore, true and fair is paramount. So the auditor tries to give an opinion, which helps to determine whether the financial statements give true and fair. Towards that, there has to be fair presentation. There has to be all the required disclosures. There has to be compliance with standards, fair evaluation of assets and liabilities, and so on. No material omissions, completeness of financial information, all that is relevant. So that we accomplish through preparing sensible financial statements based on the requirements of the law, which is section 129 read with schedule 3 divisions of schedule 3. So that is one point, sir has a lot of points on. That is one thing. So the second and the most important aspect, I think, is compliance with technical standards, or so to say, the pronouncements of ICAI, accounting standards in the preparation of financial statements. The first-hand appeal of AS and IND-AS is to the corporate accountant sitting at the other side of the table, because it's by virtue of section 133 in accounts of companies that the accounting standards have been made mandatory by the government in exercise of the powers conferred in there. Moving further, the Companies Act, then section 143, chapter 10 deals with duties, audit and auditors. And therefore there's 143 is powers and duties of auditors and auditing standards. There 143 gives all the requirements, or rather the responsibilities, reporting responsibilities of the auditors. Along with that, it says that every auditor shall comply with auditing standards. So true and fair, the reporting regulatory financial reporting framework, as we call it, the Schedule 3, then compliance with accounting standards, then compliance with auditing standards, and then of course, sir is going to touch upon a very important amendments which will come up in section 135 and CSR rules. A provision has to be made for the unspent amount. To cut the long story short, let us wait for the presentation to unfold. And as we start at the threshold of this audit season, as I mentioned earlier, it's quite heartening and quite fitting that SIRC has decided to organize this program. And sir is also, after having seen the presentation, sharing the FRRB findings, the financial reporting review board findings, which are a little disturbing. Let us listen to the presentation, stay relevant, stay tuned, ask questions, and then we would be really happy to coordinate. I'm not taking the role of any moderator, just helping to coordinate this so that we can have some interaction and of course edit certain questions and present before the expert speaker that have in Gururaj. So back to you, Gururaj sir, and wishing all the participants happy learning in the next 2.5 hours. Stay tuned. All the very best to you. Thank you so much.
Thank you, George. I have put up my presentation. Are you able to see it?
Yes, sir.
Yeah, thank you so much. A wonderful brochure designed. I'm so happy. I think it goes on to say so many things about the day. Yeah, this is the menu for the session that I've already spoken about. I'll just straight away get into the coverage of my topic. Compliance with standards on auditing. No change whatsoever with respect to standards on auditing. There have been no great change, but one thing I always keep telling that audit is all about for compliance with the standards on auditing. Accounting standards is for the preparers of the financial statements. So the owners of the financial statements are the preparers, which is actually the company and the CFO or the finance head of the company. But whatever has to be done by the auditor, for him, the most important, what should I say, book which he has to follow, the Bhagavad Gita for the auditor, is the standards on auditing. So if he is complying with the standards on auditing, I think to that extent he is safe. So we have about 46 standards split into standards on auditing 38, standards on review engagement 2, assurance engagements 3, related services 2, and standards on quality control, most important, the mother of all standards, which go on to say what should be the quality of the firm, how the firm should prepare itself, how many years should the books of accounts of the audit, the documentation should be preserved. Very interestingly, let me start off with that question. Whereas income tax says that the books of accounts has to be preserved for 6 years, and the Companies Act says the books of accounts of a company has to be preserved for 8 years. SQC goes on to say that the documentation by the auditor needs to be prepared not for 6, not for 8, but the average of the two, which is 7 years. So you'll have to preserve the audit documentation for a period of 7 years. So things like that are told in the standards on quality control, which we'll have to look into. There is no change, so I'm just brushing aside the now coming to the important standards which we need to comply with. General principles and standards on auditing. We have various series. The 200 series, the most important of them is SA 230 on audit documentation. So please ensure that the audit documentation is properly done. It is always said that an audit not documented is considered as audit not done. An audit not documented is considered as audit not done. On the CA day in Bangalore, we had one of the panel discussions which I had to moderate. One of the past presidents, Mr. Nilesh Vikamsi, had brought it on record to say that one of the things that the Big Four adhere to is 99% documentation and 1% activity, whereas it is the reverse in the case of a small and medium company. So please ensure that, I mean, in the small and medium practitioners case, we hardly document things, hardly document the discussions that happen between the client and the auditor. So please ensure that all of them is properly documented. That is what is told in SA 230. Then SA 240, auditor's responsibility relating to fraud. When you come across a fraud, what is to be done is told there. Then SA 300 series, planning or audit of the financial statement most important. Then SA and share that planning with the auditee is again a very important aspect which we have learned. SA 315 is assessing, in fact, it is studying the internal controls and thereafter assessing the risk of material misstatement, which becomes the basis when we are giving an audit report with respect to internal financial controls. When we are doing the internal financial controls, SA 315 becomes the 4. So please ensure you identify and assess the risk of material misstatement by understanding. Initially, we used to call it as the knowledge of business. We initially used to call it as KOB. The knowledge of business is now called as assessing, understanding the entity and its environment and assessing the risks of material misstatement. So that is what is SA 315. SA 450, evaluating of the misstatements identified during audit. If there are any uncorrected, what it 450 goes on to say is, how do you evaluate the uncorrected misstatements identified during audit, and what is its repercussion when you have to give your audit opinion in SA 700, 705, 706, 720 now very popularly. Then 500 series talks about audit evidence. SA 500 collecting the audit evidence. What we use always SAAE, that is sufficient appropriate audit evidence. Sufficiency means the quantification. You should have sufficient audits in terms, sufficient numbers of audit evidence to come out with an opinion, and it of course has to be qualitatively appropriate. So sufficient is with respect to quantification, that means how many samples you have picked up, and appropriateness is a qualitative aspect, both of which was discussed thoroughly in SA 500. SA 530 talks about audit sampling. Can you do an test check? Can you do what is the methodology that you adopt to pick up the samples, to consider it as an audit evidence, good audit evidence, to give an overall opinion on the entire transaction that has happened? As an auditor, naturally there is an inherent risk of you not being able to do 100% check. But then, of course, one is the control aspect and one is the substantive test. If you are satisfied with the control aspect, maybe the substantive test will be to that extent less. So how do you determine that particular substantive test audit sampling is what is told in SA 530. SA 570, a very important standard on going concern, needs to be commented upon when you are whether the entity has the inherent assumption. I mean, there are 3 fundamental accounting assumptions: going concern, consistency, and accrual. One of them is going concern, which is considered to be an assumption. So if there is there a breach of that particular assumption, and these days because of COVID there could be more such breaches, so we need to get into that particular SA 570. Point number 4 is using the work of others. Using the work of others, it could be using the work of another auditor. When you're doing a head office auditor, you may rely on the branch auditor's report, or otherwise it could be some valuer or somebody, which is called as using the work of a auditor's expert. So while we can rely on the opinion given by other auditors or other auditors' experts, we cannot blindly follow them. For example, when an actuarial valuation is given to you from the actuary, you cannot say that whatever he has told is the final. You will have to look into what are the assumptions that are taken inside to prepare that particular actuarial valuation, and find out if there are anything which is opposed. If the assumption considered there is not in line with the past trend, you will have to challenge that particular actuarial valuation. So you will have to, you as an auditor cannot blindly accept the report of the others. You will have to find out first of all whether he is a competent person, and also prima facie look into whether the job that he has done is also proper. And then point number 5 is on SA 700, 799, which Mr. Javan K. George mentioned. The end of the audit is the audit opinion, which is given out in the form of audit conclusions and reporting, covered by 700 and 700 series, out of which the most important one are 700, 705, 706, 701, 710, and 720, which I will talk a bit later. Then we have specialized areas. SA 800 special purpose framework, SA 805 special elements accounts, and 810 dealing with summary financial statements. Then we have the standards on review engagements, dealing with engagements to review historical financial statements. This is taken into account if I am reviewing the historical financial statements and I am not the statutory auditor of that particular entity, then I have to follow SRE 2400. For a limited purpose, or for somebody has engaged me, then I will do this particular follow this particular standard. 2410, review of interim financial information performed by the independent auditor of the entity, is 2410. Then we talk about assurance engagements other than audits or review of historical financial information. Other than historical financial information, that means prospective, that means projected. Very, very important. The SAE, it's called Standards on Assurance Engagement, the examination of prospective financial information. Can an auditor sign a projected financial statement? Can he sign a project report? Is what is told in SAE 3400. He cannot certify the what should I say? He cannot certify the financial information projected, but he can lend his name. He can lend his name to the extent of saying that I have. It specifically says he can participate in the preparation of the profit of or the financial forecast, provided he indicates clearly. There are certain do's and don'ts when he have to do, but very importantly, it's not a certification, but he says that the financial calculations are as per the assumptions that have been given, and the assumptions, if they go wrong, the financial statements will be not correct. So he will have to make certain observations in his audit report. I will probably put up a slide to show how the audit report for a prospective financial information has to be prepared. SA 3402 SAE is on controls at the service organization. Assurance reports on especially the IT controls at the service organization. That means if I am outsourcing it to somebody else, I am outsourcing the work of an accounting, or for that matter any other work to an outside organization, that becomes a service organization, and my financials or my controls will sort of get vitiated by the lack of controls in the organization where I have subcontracted. So that also needs to be studied, and that is covered in SA 3004 SAE 3402. Then SA 3420 talks about prospectus, which I will not talk about today, but related services, out of which the most important one is 4410, compilation engagements. So this year especially, a lot of banks would tell the companies that since the audited financials are getting delayed because of lockdown, you do one thing: you get a provisional financial statement certified by your chartered accountant. The million-dollar question is, can the chartered accountant certify a provisional financial statement? The answer is given by SRS, Standards on Related Services 4410, compilation engagements. The auditor can give a certificate, but the way in which it has to be given is very clearly told. It cannot just be a seal and a signature on the provisional financial statement saying that as per agreement with the books of accounts. If it is done like that, that is not considered to be a good compliance. It has to be followed by a proper audit report. We will see how an audit report on that would look like. SQC1 I have already talked about. So this is the format. This is the SAE, Standards and Assurance Engagement 3400. While drafting a prospective financial statement, while a financial statement can be prepared, you cannot just put a seal and signature and say that it is all fine. It has to be within a particular format. And if it is just given as a certificate, please note that the chartered accountant may be considered as guilty of professional misconduct under Schedule 2, Part 1 of the CA Act. Please ensure that. So what is the solution for that? CA can participate in the preparation of the profit or the financial forecast and can review them. He can also review them, provided he gives a clear report, and in his report he indicates the source of information, where is the information gathered from, the basis of the forecast, the major assumptions, and he does not vouch for the accuracy of the forecast. The format in which the report has to be given is also given there in the illustrative format, and it reads something like this: based on our examination of the evidence supporting the assumption, nothing has come to our attention which causes us to believe that the assumptions do not provide a reasonable. In fact, look at this. It is, the opinions can be of three types: an absolute assurance, a reasonable assurance, and a negative assurance. For all limited review purposes, we chartered accountants don't give an absolute assurance. If it is an absolute assurance, it is not an opinion, it is a matter of fact, and a matter of fact will be a certificate. It will not be a report. The fundamental difference between a report and a certificate is, a certificate is of course a matter of fact, and to that extent it is an absolute assurance. There we say the turnover of the company is 5 crore 55 lakhs 375. So that is a matter of fact. But when it comes to true and fair, a fair presentation, what Mr. Jamin K. George was talking about, when we are opining on the true and fairness, we cannot be absolutely assured. Rather, we cannot assure the readers of the financial statements. So therefore, we always say it is a reasonable assurance. It's a reasonable assurance. Now, a step below reasonable assurance is the negative assurance, like what we have done. We say that nothing has come to our attention which causes us to believe that assumptions do not provide a reasonable basis for the forecast. Further, in our opinion, the forecast read with the notes thereon is properly prepared on the basis of the assumption, and we are saying, we are drawing their attention to the assumption and saying that as set out in note 10 and on a consistent basis with the historical financial statements, and it is in line with the past, and the assumptions are considered for making the projections. Using appropriate accounting principles, actual results are likely to be different from the forecast, since anticipated events might not occur as expected and the variation might be material. So we are warning that the reader that there could be a variation from the what has been given in the report. So coming to SA4 standards on auditing audit engagement 4410, while drafting the report. Now, if I'm preparing a provisional financial statement, if I'm drafting a sorry, this is not SAE, it is SRS. It's standards on related services. I should have made a correction there. It is 4410. It is compilation engagements. So if I am asked to prepare a provisional financial statement, I will call it as a compilation engagement and not sign and seal the financial statement and say it is as per agreement with the books of accounts, like we used to do it in the earlier times. Now we have to give it give the provisional financial statements and append it with and cover it up with a proper audit report, like we give it for SA 700 audit report, where we say on the basis of the accounting records and other information and explanation provided to us by the management, we have compiled the unaudited balance sheet. The management of the company is responsible, like the responsibility paragraph is also given. Then in the last paragraph, we are going to say the balance sheet and profit and loss account are in agreement with the books of accounts. We have not audited or reviewed these financial statements and accordingly express no opinion thereon. So both for this SRS 4410 and SAE 3400, you are supposed to sign and generate a UDIN also. The third question that keeps coming out is whether I can certify the income tax return of an individual, which is required for bank loan purposes. The chartered accountant is not a notary. It is a notary's job to say that I have seen the original and I will put a stamp and sign and say as certified as per the originals. No, we are not equivalent to notaries. We are given a power to give our audit report and an opinion in the form of a report. So anything which comes to us should be done only through a report and not just a seal and signature. So members are not authorized to certify income tax return as true copy. However, they can make an opinion certificate report about the income tax return based on its source, location, and authenticity of the data from which the income tax return is being prepared. Even for this work, UDIN has to be generated. Is there any change within these standards, the most important standards which become the end product of an auditor is the audit report, the audit conclusions? Is there any change for this year? Like you just have to continue what you did the last year. I mean, in terms of formatting, in terms of understanding, etc. But of course, if there are any qualifications which were not given last year, but if it is there in this year, please ensure that you properly qualify. Or if there are qualifications last year and this year it is a good financial statement, you don't have to give the qualifications. So SA 700 deals with the auditor's unmodified opinion.
Gururaj sir,
and then
small interruption now. Selva, Sorry, please.
Yes, sir.
Please, sir.
I'll just finish off this slide, then I'll open it for you. Okay. The SA 700, SA 705, modification to the opinion. So whenever you are giving a qualified opinion, you will have to comply with SA 705. SA 705, all of us know by now that it starts with a qualified opinion and then the qualification and then the other aspects. So SA 705 deals with the modification of opinion. Modification can be of three types. It could be either a qualification saying that subject to, except for, in fact, you should not use the word subject to, except for what has been told above, the financial statements are true and fair. That is a case of a qualification. Then we have a case of adverse opinion. The financial statements do not reflect the true and fair aspect of the financial whatever. So you'll have to say do not provide a true and fairness. Clearly, that is called as adverse. Very rarely we give that. Of course, if it is required, we may have to give that. And instead of giving that, a lot of auditors are now deciding to give a resignation. That is a different subject altogether, which is provided in SAF 705 itself. The third type of modification could be disclaimer of an opinion. Disclaimer of an opinion. That means I do not express an opinion on the true and fairness of the financial statement. Can such a statement be given? The answer is yes. There are a lot of statements which I have seen where a disclaimer of an opinion is also given. Is that a final? That answer is that is also considered to be an audit report in itself. SA 706 deals with the two very important aspects: emphasis of matter and other matter paragraph. What is an emphasis of matter? Let us be very clear. An emphasis of matter paragraph is a matter which has been properly dealt with in the financial statement, and there is a note regarding that aspect in the financial statement because it is important in the financial statement. But the auditor now feels that that matter is so fundamental to the understanding of the reader of the financial statements that he also in his audit report would like to emphasize that particular note in the financial statement on a matter which has been properly dealt with in the financial statements. That is about emphasis of matter. What is an other matter paragraph? An other matter paragraph deals with any aspect of audit, which the auditor wants to express. For example, he would like to say that two of the branches which are remotely located and do not have too much of activity has not been audited. So that will comprise a very small percentage. It has not been subject to audit. So if you want to say something on that, you can put it in your other matter paragraph. Or in a consolidated financial statement, the auditor will say that the branches, the subsidiaries have been audited by some other auditors, and I have considered them for the purpose of giving an opinion on the consolidated financial statements. So any matter related to audit which the auditor want to express can be expressed through a paragraph called the other matter paragraph. SA 720, very interesting, I'm sure all of us know by now, is that in the annual report, which is a thick book, there are a lot of information other than audit report and the financial statements. Now, if you remove the audit report and the financial statements from the annual report, what remains is the other information. So that other information, we as auditors have not audited it. But the reader of the financial statements, for him, it is not only the financial statements which have been audited, the reader thinks that the entire annual report is audited. So to help the reader in a better understanding, there has to be consistency between, let us say, a management discussion and analysis, or a chairman's speech, or a director's report, or anywhere else, any graphs that are given in the annual report. They should be in sync with the audited financial statements. Let us say the audited financial statements talks about a turnover of 500 crores, whereas in the management discussion analysis, they say, we are very happy to say that our turnover increased from 470 crores to 540 crores. Now there they are talking about 540 crores including GST, but in the audited financial statements, it is 500 crores net of GST. So we will have to now tell them, hey, you cannot have a different figure in the director's report, which is not in concurrence with what is there in the financial statements. So I, as an auditor, will have to give an opinion on the other information also. Now, how should I give the director's report and the management discussion analysis comes later on. So how the reports have to be given, if it is given before my signature, is told there. If it is given after my signature, how I have to take care is what is told in SA 720. So please follow that. SA 701, very important for listed companies, mandatory. For other companies, it is optional. What are those key audit matters which are a critical audit matter, which you have come across and which you spend more time on, and finally you concluded that it is all fine. It is all fine. But then you are now telling the auditors, telling the clientele at large, I mean, not only the clientele, the stakeholders at large, what are those critical aspects which came across, which you have come across during the course of your audit, and how you have properly convinced yourself to say that that has been properly taken care of. So that is to be given for listed companies as a matter of must. Even if there are no key audit matters in a listed company, they have to give a paragraph to say that there has been no key audit matter, and hence we are not opining on that particular subject. For all other entities, it is optional. SA 710 deals with comparatives. I'm not going to talk about that. Applicable, please understand this entire reporting format. Don't think that it is applicable only for companies. It is also applicable for non-corporates. Yes, sir. Now I come to the second bit of my topic, which is change in accounting standards. Before that, over to you, George.
Thank you so much, sir. Excellent going. Your grip of the subject is so fast. I mean, so strong that it's like a cascade that your presentation is flowing through. I was sorry for the interruption because Selva, that's a question. How to maximize the screen? I think for the audience, we are seeing it as a small screen at the between the panelists, but for the members, it's a full screen, right?
It's a full screen only, sir. Full screen.
Full screen. So there's a question how to maximize the screen. Yeah.
No. If initial stages before sharing the presentation, it might be in a minimal mode if they have joined from mobile. Now the screen sharing started, right? So it will be a maximum screen only. Those with mobile only. For those who are joining in laptop or something, it will be a full screen.
Fair enough. You are tabulating the chats, no?
Yes, I am compiling. I have compiled nearly 10 questions as of now. So whatever came up, if you want, I can post.
Are the questions forthcoming? So Gururaj sir, since because you have finished the introduction in standards and auditing, can we take the questions now?
Sure. We can take.
Yeah, that's better because before you share the screen. So this is the complete overview of standards and auditing touching upon, because in my introduction, one thing I left out, though I mentioned about opinion in the report. The informed reporting is also an important aspect of audit, which some of us are a little passive about. Audit report cannot be a copy paste from the previous year. So Sir has in the roundup touched upon SA 700, of course 701 key audit matters, 705 modifications, 706. All these standards have to be read, understood, threadbare. It's just a click away on Google. You don't have to refer to books today. If you look up for SA 700 ICAI, you will get downloads, PowerPoint presentations, and so on. So I think members who are new, members who come back from abroad, those joined practice recently, I think should educate a lot and make use of sessions like this. So Selva, those questions which are there, if you could show, I could probably edit it. You have tabulated like you can display on the screen.
I don't know, this belongs. I have compiled from here. Take belong questions. Belong.
Okay, the company has not been able to claim its MEIS from 1/4/20. There is uncertainty on the receipt of the same in the near future as no funds are allocated to screen by Government of India. Should the company recognize this as income? AS1 says prudence and certainty. The amount to be claimed is ascertainable. What should be the auditor? What should the auditor do? Is it to be qualified or just stated in the notes on MEIS? I'm sure sir would know that Merchant Export India scheme like SEIS.
Whatever it is.
So
the point I would like to answer quickly. We have to go very quickly on all these questions. So I would like to say, whenever there is an uncertainty, please don't recognize it. And Accounting Standard 9 goes on to say that you shall disclose any revenue which you have not recognized by virtue of it not being certain. You will have to make that point in your financial statement. Please don't recognize that unless you have certainty. And mention that what are the revenues you have not recognized because of uncertainty in your financial statements. Next.
I think that answers the second part of your question also. ROTEP also same way. Now, second question is, at the time of transaction occurred, before 31st March, no related party existed. But as on 31st March 2021, related party exists, then is it necessary to be shown as related party transaction as per Ind AS 24? IAS 24 as well as IAS 18. Yeah.
I think that's a very, very interesting question. I would say that if the transaction at the time of transactions they were not related, then there is no way that you could have done a compliance. Related party transaction, let us understand, it is not a matter of reporting. It is a matter of compliance. You should have done certain compliances. If they were not related party at that point, in my opinion, the question of complying with section 188 would not arise. Now, talking about related party disclosures and under Ind AS 24 or accounting standard 18, again there I would say at the time they were related. So even for that purpose, I am of the opinion that it need not be given as related party transactions.
Is sale of vehicle in the ordinary course of business for section 188? If yes, for which all companies?
No, I mean, there are a lot of transactions which are considered as ordinary course of business. So sale of a vehicle could also be, this is a very highly subjective point, but our institute also, in a few cases, they said giving out rentals of the properties which the company has, is it in the ordinary course of business? Means they have opined it as yes. So here, even this could be considered as yes. So it could be in the ordinary course of business.
While certifying quarterly stock and book debt statements of audit clients, which standard should be other two, please?
I mean, it is mostly to do a certification and not an opinion in that sense. But in any case, please gather all sufficient appropriate audit evidence. So I would say the standard which deals with audit evidence, maybe SA 500 would be the nearest standard that you will have to comply with. Of course, you have to gather enough evidence to satisfy yourself about the genuineness of the fact that you are giving there.
It's more of a SAE, assurance engagement, I think. Yeah. Does provisional report require UDIN number?
Yes, the answer is yes.
Okay. Bankers are insisting on for UDIN for 44 AD or 44 ADA cases. Can it be given? It should be given now, sir.
The bankers are insisting for UDIN for 44 AD and ADA cases. That means 44 AD, I presume that 44 AD is not a tax audit case. That means he is giving less than 8%. Less than 8%. And so therefore, the question of certifying the financial statement does not come into picture at all. But in case the auditor is certifying for whatever reason, then he will have to do do a proper audit, and see SF. Let us be very clear. For the banker may put additional conditions. Income tax department may say under 44 AD, I don't need your books of accounts. I don't need your books of accounts as long as you tell me what is your turnover and 8% of that you pay, I'm happy. But if the banker says that he needs a financial statement and that financial statement has to be audited, then it will not anymore be a 44 AD financial statement. It will be a financial statement which is independent of 44 AD, which the auditor is giving, and for that particular financial statement, auditor has to prepare a proper audit report and generate a UDIN.
Yes, sir. Opinion as per SIE 3400 to be given in CMA report for bank loan purpose, right?
To be given in CMA report for bank loan purpose. Yeah, I mean, you may say that. Basically it is for bank loan projections. You may do projections not only for bank loan, it could be also be for valuation, DCF, for whatever other purposes also.
Sir, if I may just add, CMA report doesn't require auditor signature. It is purely a matter of internal management prepared by the management. So SIE 3400, please be informed it's on prospective financial information. Of course, in CMA also, I think we are giving 2-year projects. Just adding on to that. Can we give certificate on estimate to construction factory building for the purpose of getting registered with population control board, pollution control board it should be, and obtaining certified copy of estimate from engineers will be sufficient?
Please understand, our auditors cannot give a certificate of the estimation. It is, I cannot give a certification of the estimation. The answer for the simple reason is no. The answer, we cannot give a certificate for the things to happen.
Sir, most of the bigger firms are providing the EOM para for COVID-19 impact on the financial statements. What is your view on this?
Now, if the company is giving that, see, most of the bigger firms, I mean, when he is talking about probably the bigger audit firms are providing a EOM paragraph. See, EOM is a matter of right to the auditor, and if somebody is giving that, I cannot come in his way. Now the question is, should I also give that EOM paragraph? If you feel that the company is giving certain aspects with respect to COVID, which has affected you or your going concern in a big way, if it is with respect to the going concern, it cannot be a EOM paragraph, but a separate paragraph on going concern has to be given. But if it is on any other matter, if you feel that it is fundamentally important for the reader of the financial statement, you may give that. I think we should stop here because I have to go ahead.
One last question, sir, if it's okay. Can you please highlight the importance of material uncertainty paragraph on going concern? This is very important for the present COVID-19 situation. Clients still believe that EOM on going concern is sufficient. Clients still believe that EOM on going concern is sufficient. However, this is not applicable as of now.
Perfect. In fact, I answered this question without reading this question itself. If the matter, there is a material uncertainty paragraph which got introduced when the revised SA 700 came into picture from 1/4/19 onwards, wherein if there is anything to be done with respect to the revised so 1 second, please close. Okay. With respect to the going concern, if it is getting affected, let us be very clear how to deal with that particular paragraph. If there is a issue with respect to going concern and the management has convinced me that there is no problem, we will be able to face the going concern issue by virtue of the support of the parent company, or the promoters are going to put in funds, then I will have to bring in this paragraph. Material uncertainty with respect to going concern is a separate paragraph and does not form part of EOM like it used to be before the revision of SA 700. So now it has to come in as a separate paragraph. But that paragraph is only when the auditor is himself convinced there is an issue. Apparently for the reader, there may be looking like there is an issue with respect to the going concern, but the auditor has got himself convinced that the company will be able to overcome that particular uncertainty. Then he will bring out that reason for uncertainty, and also bring out a fact how they are able to overcome that particular thing. Then it can come under that paragraph. If, however, the auditor feels that the uncertainty is going to be there, if the uncertainty is going to be definitely there, the auditor is himself not very satisfied, then he should ask the company to redraft the financials, as though going concern is affected. And if the company is accepting to that, then he can give a clean report. Otherwise, if the company says that no, we are very sure that the going concern is not affected, but the auditor himself is not convinced, then he has to qualify that particular audit report. Yes, sir. Shall we proceed? George, can we proceed?
Yes, sir.
Yeah. Okay. Now let me.
Yes, I was muted. I was just throwing a thumbs up. Yeah. Sorry. Please resume, sir.
Changes in accounting standards. Now there is a lot of, you must have seen a lot of places that accounting standards have got changed, and how do you deal with this particular accounting standard changes? Let me tell you, companies accounting standard rules on 23rd of June, I mean last month, on 23rd of June, companies accounting standard rules came out with a 388-page document. Now, what is this 388-page document? Have they materially changed the accounting standard 1 to 29? If you read verbatim, it is a reproduction of what is already there in the company's accounting standard rules, has brought in as company's accounting standard rules 2021, barring for 2 changes. Let me tell you, one of the changes was they changed the criteria for determining whether a company is a regular company or a small and medium company. All these days, a listed company, a bank, financial institution, or an insurance company, and a company with a turnover of more than 50 crores and a borrowing of more than 10 crores, or a holding subsidiary of any one of them used to be considered as large. All other companies were considered as small. Now the criteria for turnover, they have upped from 50 crores to 250 crores. Similarly for borrowings, they have increased it from 10 crores to 50 crores. First point to be noted is this is to be effective from 1st April. Accounting periods commencing from 1st April 2021. That means for the financial period 21-22, you will have to apply this particular criteria. Until the financials of 2021 for which we are doing the audit will go with the earlier criteria of 50 crores and 10 crores. That means if the turnover of the company is 60 crores, you will consider that as a small as a regular company and not as a small and medium company. The advantage of being a small and medium company is you have been given relaxation with respect to certain accounting standards. Where are those relaxations told? The relaxations have been told in the respective accounting standards itself. Now the question is, from next year onwards, from the current year onwards, if my turnover is more than 250 crores, then for next year I will use that particular yardstick to talk about the new standard. Now, why the hell did they bring in a 388-page document to tell this? This is the only change. Why did they bring in a 388-page document to tell this? Let me tell you. Companies accounting standard, when the Companies Act of 2013 was formed, in Companies Act 2013, we do not have an accounting standard. Companies accounting standard for the moment, what we are following at the moment is Companies Accounting Standard Rules 2006. Companies Accounting Standard Rules 2006 was prevalent in 1956 Act. In Companies Act 2013, when it was introduced, they brought in a rule number 7 in Companies Accounting Rules 2013, where they said till such time the accounting standards are notified under this act, you follow the Companies Accounting Standard Rules 2006. So therefore in all our financial statements, we used to say that the company has followed Companies Accounting Standard Rules 2006 read with Rule 7 of Companies Accounts Rules 2014. So we used to talk about this. So GAAP comprises mandatory accounting standards as specified under section 133 of the Companies Act 2013, read with Rule 7 of the Companies Accounts Rules 2014. We were in fact following Companies Accounting Standard Rules 2006 until this notification came. And from the time this notification has come, now we have the Companies Accounting Standard Rules 2021 as part of the Companies Act 2014, and we don't have to anymore refer to Rule 7 of the Companies Accounts Rules 2014. But please understand that for financial year 2021, you still have to go with the Companies Accounting Standard Rules 2006 read with Rule 7 and the earlier criteria of 50 crores and 10 crores of borrowing. Please understand when I say, for example, a company's turnover is 60 crores, but the borrowing is 7 crores. Because any one of them breaching, you are going into the higher level. To put it the other way around, if your turnover is 40 crores and your borrowings were only, maybe your turnover is 40 crores, but your borrowing were 11 crores, then also you will not be a small and medium company. Any one of them breaching, you cease to be a small and medium company. If by virtue of your being a small and medium company, you are getting certain relaxations such as you don't have to prepare a cash flow statement, you don't have to prepare a segment reporting, and you are given certain exemptions with respect to certain standards, like for example accounting standard 15, there has been certain relaxation. I will show you that through a proper slide. And accounting standard 19, there have been disclosure requirements have been relaxed. Accounting standard 20, earning per share, you don't have to give a diluted earning per share for an SMC. Accounting standard 28, when you are calculating the impairment of an asset, how do you calculate an impairment of asset? You compare the carrying value of the asset with the net recoverable value. What is the net recoverable value? Net recoverable value is the higher of the value in use, or the net selling price. What is value in use? You estimate how much you are going to earn out of using that particular asset in future and bring it down to its net present value using the discounting factor. So this particular thing can be a very big exercise for a small and medium company. So there they said, instead of going in for value in use, how many years that asset will be in operation and how much earnings you will earn every year in the future, and bringing it down to its present value, you can consider that value in use as a reasonable estimate instead of computing it by the present value technique for a small and medium company. Accounting standard 29 is on provisions, contingent assets and contingent liability, whereas you will have to calculate what is the provision You'll have to calculate what is the provision, but such a provision need not be, there is an elaborate disclosure to be given with respect to each of the provision, but such a provision disclosure need not be given for a small and medium company. Now, in all these are relaxations for a small and medium company. If you're adopting this relaxation, you will have to give a paragraph at the end of the financial statements, I mean in the notes to the financial statements, that the company is an SMC as defined in the general instructions in respect of accounting standards specified under 133 of the Companies Act, read with Rule 7 of the Companies Accounts Rules 2014. Accordingly, the company has complied with the accounting standards as applicable to the SMC. So that is a note that you have to give. So we move to the next aspect, which is the change in the criteria for determining what is a in the case of a non-company, that is a non-corporate entity, how do I determine the levels? All these years we used to have only 3 levels, level 1, level 2, level 3, but now because under the MSMED Act they have 4 levels. Although MSMED Act defines micro, small and medium 3 levels, and anything other than this is large. So therefore you have 4 levels considering large. In the same manner, this year what our institute did was they have also defined for a non-company, instead of 3 levels, they have gone in to define 4 levels. Now what are those 4 levels? Earlier also it was based on, the levels were based on turnovers and borrowings. Now also that particular criteria continues. Now instead of, just like in the case of a company, 50 and 10 was the criteria. In fact, it was our institute which first changed 50 to 250 and borrowing from 10 to 50, and the NACAS and the companies and MCA has now fallen in line, as we saw now, because this particular scheme came only on 23rd June 21, whereas this came much earlier. I think 6 or 7 months before that only our institute in the council had already passed this particular revised criteria. But one fundamental difference between this and for companies and non-companies is, for companies, the revised criteria is applicable for financial year 21-22 onwards, but for non-companies, the revised criteria is applicable for, it has a retrospective effect from 1/4/2020. That means for financial year 2021, the audit of non-corporate entities has to follow the revised criteria. So which means if my turnover were to be 60 crores, then I will not be a level 1 company, rather I will shift to level 2. Under the old criteria, 50 crores was the cutoff for turnover determination. Now it is revised to 250 crores and borrowing of 50 crores. There could be other criteria by virtue of which, although your turnover is less than 250 or borrowing is less than 50, by virtue of other criteria, you could be a level 1. What is that? You are a listed entity, or you are a bank, financial institution, insurance company, or a holding or a subsidiary of an entity which is covered under level 1. So you yourself may not be level 1, but you are a subsidiary or a holding company of an entity which is a level 1, in which case you also have to be level 1. So similarly for level 2, they have revised the criteria. Earlier it was 1 to 50 turnover, now it is 50 to 250. For borrowings it was 1 to 10, now it is 10 to 50. Other criteria could be you are a holding or a subsidiary company covered under level 2. Level 3 is up 10 to 50. Borrowings is 2 to 10, and other criteria, of course, you are a holding or a subsidiary company covered under level 3. For level 4, which is a micro, now newly introduced, it was not there. Although our institute does not use the word micro, small and medium, I have brought in a semblance of the equivalent of micro, small and medium for this purpose. Our institute uses only level 1, level 2, level 3, level 4. So for level 4 means up to 10 crores turnover. Please understand, this turnover will not match with the MSME turnover. So a company can be a micro up to 5 crores for the purpose of MSME, but for the purpose of level 4 up to 10 crores turnover, they are still considered as level 4, not micro in that sense. Whereas the criteria for MSME is based on turnover and investment in plant and machinery. For the purpose of determining the levels, it is not investment in plant and machinery, but based on the borrowings. So these are fundamentally the difference between MSME and the criteria for non-companies. Now, how do you understand this particular criteria? All figures are rupees in crores. Falling in any one or more criteria, what it means is, I already told you this, if a company's turnover is let us say 200 crores, but its borrowing is 60 crores, So any one of them breaching, it falls in the higher bracket or the higher level. Engaged, does accounting standard apply to every entity? Let us say a charitable organization, does it apply? Or to a club, does the accounting standard apply? The answer that is given is it applies to every entity engaged partly or fully in commercial, industrial or business activity. So if such a charitable organization has a commercial activity like renting out its hall or selling some books or any such matter, instead of just taking charity and giving charity, then that doesn't really enter into the area of commercial, industrial or business activity. But if such a charitable organization or a club engages in commercial, industrial or business activity, then accounting standards will apply to them in totality. Now, as far as the turnover is considered, it is in the year, in the whole of the year. As far as the borrowings are concerned, at any time during the immediate preceding accounting year. So how I will look into it is, if in year 1 it complies with, then in year 2 I will ensure that all the accounting standards are followed. I mean, it is not for the same to same year. The year before is the benchmark based on which I will determine for this year whether it is considered, what levels it fits into. Then figures in the bracket are earlier year criteria, not applicable to non-corporates required to follow Ind AS. So for whatever reason, if the entity has to follow Ind AS because it is a subsidiary of an entity which is required to follow Ind AS, then this criteria will not apply. So small and medium companies other than level 1, revised criteria with effect from 1/4/21. But as far as non-companies are concerned, it has a retrospective effect. Now let us see what are the relaxations and exemptions permitted to non-corporate entities. Full exemption for level 2, level 3 and level 4, full exemption of cash flow statement, segment reporting, earning per share. Then 21-23 does not anyway apply consolidation. 25 interim financial reports and 27 is on joint venture reporting, not applicable to level 2, level 3, level 4. To level 1 entity, all for a level 1 non-corporate entity, all accounting standard 1 to 29, excluding of course AS 6 depreciation and AS 8 on research and development, which is anyway not there for anybody. All 27 accounting standards will be applicable for level 1 entity. For level 2, 3, 4, this is fully exemption is that. Level 3 and 4, of course, all of them will continue. Apart from that, for level 3 and 4, related party disclosures and discontinuing operations will not be applicable. And in addition to that, for level 4, amalgamations and impairments also will not be applicable. Partial exemptions with respect to accounting standard 15. We will see the similar partial exemption is also available for SMCs also. Very interestingly, for level 4 entities, what is a level 4 entity? You look into this. Most of our clients of non-corporate entities will be in that bracket. Turnover of less than 10 crores and borrowing of less than 2 crores. For such type of entities who fall under level 4, you don't even have to calculate deferred taxes. Accounting standard 22 will be applicable only for calculating the provision for current taxes. Deferred taxes will not be applicable for them. Of course, there are certain disclosure relaxations given for such entities. As far as level 2 and 3 and 4 are concerned, the disclosure relaxations are with respect to accounting standard 19 leases and 29 provisions contingencies, which will continue. For level 3 and 4, additionally, you will have accounting standard 10 and 11, property, plant and equipment and forex conversion, as certain disclosure requirements are exempt. And apart from that, for level 3, level 4, investments and intangible assets, there are certain relaxations with respect to disclosures only. Now, what are the relaxations available for a small and medium company and for level 2 and level 3 enterprises when it comes to accounting standard 15 employee benefits? We have seen employee benefits, gratuity. Gratuity is a very important calculation, provident fund or retirement benefits. All these things have to be properly actuarial assumptions, and that is the most complicated standard for a non-company audit. When it comes to Ind AS, I always say financial instruments are most complicated, but for non-companies, accounting standard 15 is the most complicated. So of course we rely on the actuary to do all those work, but should an actuary be employed in the first place? First thing I have to tell you is provision of Gratuity Act will not be applicable to an entity with less than 10 employees. That's the first point to be noted. The second point to be noted is if the company or the entity has employed more than 10 years, but the entity itself has been there only for 2 years. We know that gratuity for the moment is applicable for all those employees who have completed 5 years of services in the company or the entity. Now, if the company says that none of the employees have completed 5 years, so therefore I am not providing for gratuity, then the answer is wrong. Please understand that the requirement, the accrual of gratuity happens during the course of the employment. If you follow that standard saying that I'm only after the 5 years of completion and I'll account for that particular gratuity, then I'm afraid in the 6th year when he completes 5 years, for all the 6 years, your profit and loss account will take a hit in 1 year itself. So that is not the objective of accounting standard 15. It should follow the project unit credit method. That means as and when the employee is working for the organization, his cost should be loaded. And when you talk about a project unit credit method, imagine a projector, a film projection which happens. At the projector stage, it will be very thin. The beam will be thin, but when it goes and hits the screen, it will be a wide angle in that sense. So what it means is, in the initial year, the debit to the profit and loss account will be lesser. In the later years, as and when the employee is more and more experienced, the debit to the profit and loss account on account of his giving back, on account of his gained experience, should also be a higher debit to the profit and loss account. So that is how the PUCM method is built in as far as accounting standard 15 is concerned. So level 1 enterprises in all companies except SMCs, entirely it has to be followed. Level 2 and 3 enterprises, there is a further differentiation. If the average number of employees during the year is more than 50, first of all, level 2 and level 3, and then the average number of employees employed during the year is more than 50, and to all SMCs, whether or not that SMC is having less than 50 or more than 50, this particular rule B will apply. Accounting standard 15 is applicable in totality except the following. Now we know that there is a defined, whenever you are calculating employee cost, if it is actual means you will anyway debit it, but if it is a projected, then we'll have to see whether it is the employee cost is a defined benefit plan or it is a defined contribution plan. When it comes to a defined contribution plan, the difference fundamentally is who will bear the risk and reward of the future actuarial assumption changes. If the rate of interest goes up or the rate of remuneration goes up, who will bear the risk in future? If the company is bearing that particular risk of the future actuarial risks, then it is called as a defined benefit plan. Defined benefit plan. If the other party, let us say in the case of provident fund, I will pay to the provident fund authorities, and whatever inflations or rate of interest changes will have to be borne by the third party, that is the provident fund authority, then it is called as a defined contribution plan. When to understand it easier, defined contribution means I fill it, pay it, and fill it, shut it, and forget it. I will pay that and I'll forget the actuarial risk. That is a very simple accounting. I mean, I always say this, Jamanji, that defined benefit plan is no benefit for the accountant. I mean, it is no benefit to the company also. Actually, they have to bear the actuarial risk. I don't know why they called it as defined benefit in that sense. What they mean is the benefit has been defined, how much the employee will get. In fact, Panarat sir, you will also be happy, and Jamanji, you know that when we are measuring the employee benefit, it is we are being very your video. Sir, I think you'll have to switch off your audio. Yeah. What I was trying to say is the defined benefit is no benefit to the company. In fact, the employee benefit itself, it should have been an employee cost. It should not be employee benefit in that sense. What you are debiting to your profit and loss account is your employee cost, but we are very being, so positive in our approach that we are saying that we are recording the employee benefit as a cost in our, so therefore bigger companies, we call it as employee benefit cost. Actually, it is no benefit to the company. It is employee cost. For the employee, it is a benefit. For the company, it is actually a employee cost. To that extent, it is a misnomer. Having said that, just like that, defined benefit plan also is not a benefit to the company. The benefit available from that particular plan is made available to the employee, made known to the employee, and that benefit the employer has to bear the entire risk, and that is which cannot be passed on to the third party. Therefore, the calculations are very tough when it comes to defined benefit plan, and we have to take the help of an actuary. But for a level 2 and level 3 enterprises with the average number of employees lower than 50, and to a small and medium company, they have been given the following relaxations. The recognition, measurement, presentation and disclosure in respect of defined benefit plan for post-employment and other long-term employee benefit plan, they have to follow that, but they should use actuarial method to measure and recognize. So what they are saying is, they are given this benefit with respect to defined benefit plan. You don't have to go to an actuary, but you can measure and recognize using a project unit credit method without going to a actuary, and disclose the actuarial assumptions. So as far as the second exemption available to such entities are recognition and measurement of short-term accumulated compensated absence, which are non-vesting, can be relaxed. Now, discounting amounts payable after 12 months of balance sheet with respect to defined contribution plan and termination benefits also need not be complied with by B type of entities. Now we go to the C type of entities, which is level 2 and level 3 entities. If average number of employees during the year is less than 50, and for level 4 entities, irrespective of the number of employees, there has been additional relaxations. What are these? Recognition and measurement liability and expenses regarding defined benefit plan with respect to some other rational method. They don't even have to follow a project unit credit method. I can just follow saying that I'll assume that all the employees retire today, and that is a method I can follow and debit that much to the profit and loss account. Accordingly, there is no requirement of any disclosure into the actual assumptions. So additional requirement, anyway, I will skip this. There, the slides will be available. How you will meet with the situation when you have changed from one level to another level. But the simple thing we have to notice is, if we have moved from a lower level to a higher level, level 2 to level 1, let us say, I don't have to give the comparative figures of the last year because I never did that. That is one benefit which is given in situation 1. In a situation 2, what he says is, you moved from a higher level to a lower level. That means from level 1 to level 2 or level 2 to level 3. Then you will not be taking the benefit available to the lower level entity immediately for the next 2 years, till such time you are sure that you are going to go down in that particular level and retain in that particular level. You will not shift. Those relaxations available to the earlier levels, relaxations available to the lower entity will not be availed by such an entity till you complete 2 years of practice. So what are the other notes? Disclosing notes for an MSME also, for a small and medium enterprise also, for a non-company, you will say an MSME which avails the exemptions or relaxations given to it shall disclose the fact that it's an MSME, the level of MSME, and that it has complied with the accounting standard insofar as they are applicable to entities falling in level 2 or level 3 or level 4, as the case may be. And you will say, availing the exemption is an option. You can avail certain standards and you cannot avail certain standards exemption, and within that certain paragraphs also you can delete, if as long as it is not misleading. So that is the requirement. And what is the requirement for the company's requirement, which Mr. Jaman K. George talked about? Section 129 says the financial statement shall give a true and fair view of the state of affairs of the company, comply with the accounting standards notified under 133, and shall be in the form or forms as may be provided for different class of companies in Schedule 3. So most important is that it has to be true and fair, following accounting standards, and follow the Schedule 3 requirements. Failing which the company will be punishable with when I say the company, the non-compliance, the managing director, whole-time director in charge of finance, CFO, or any other person charged by the board with the duty of complying with the requirement of 129, and in the absence of any of the officers mentioned above, all the directors shall be punishable with the imprisonment for a term up to 1 year, or with a fine of rupees 50,000 or rupees 5 lakhs, or with both. Now, this is as far as the preparers of financial statements are concerned. What about the auditors? Auditors to report whether, in his opinion, the financial statements comply with the accounting standards. Now, what happens if the auditor does not give his opinion on this? Then there is a penalty for contravention of 147 which was told in 147 has been dropped. Very interestingly, this will be a matter which will be taken up by our institute for disciplinary proceedings if it comes for such companies. Otherwise, it will go to NAFRA. Now, FRRB, possible actions for non-compliances, for material non-compliances affecting the true and fair view. In fact, our institute has a board called the Financial Reporting Review Board, where the financial statements, either based on complaints or on suo moto basis by the institute, will be picked up for technical scrutiny, which of course the ROC also keeps doing. Our institute also does that, and I have been associated with this Financial Reporting Review Board for the last 15 years. So where the technical mistakes are found out, and if any non-compliances with respect to any standards or Companies Act or Schedule 3 requirements are not followed, then the matter will be taken up against the company by the concerned regulator. But as far as the institute is concerned, it will take up the matter against the chartered accountant, depending on what type of non-compliance it is. If it is a matter of a small non-compliance, a technical non-compliance, then an advisory will go to the auditor saying that next year you please take care of that. And also during the course of peer review, this matter will be taken up whether it has been actually adhered to in the subsequent years. If the matter is very serious, such that the non-compliance has led to affecting the true and fairness itself of the financial statements, then the matter can be referred from FRRB directly to the Director Discipline. So there is a book released by the institute called the Deficiencies Observed by FRRB, where they said which accounting standard has not been followed properly, or which of the non-compliances were the most not visible by the institute. Audit requirement not complied, and unqualified opinion. Now, some of the non-compliances I'm just telling. Our institute during the FRRB, they have said, the auditor has said that in our opinion, the balance sheet, profit and loss account, the cash flow dealt with by this report comply with the accounting standard referred to in 133. Whereas we have seen that the company, there were lot of non-compliances with respect to the accounting standards. So please ensure, and whenever a serious accounting standard is not properly complied with, it can definitely not be a technical mistake. A technical mistake could be like, one item in the Schedule 3. There is a B, C, D in which it has to be given. If A is given as B and B is given as A, that also one line interchange in a Schedule 3 is considered as a technical mistake. That will be observed as a technical mistake, and an advisory will go to a chartered accountant. A non-compliance of an accounting standard mostly will affect the true and fairness of the financial statements. So therefore, it could lead to disciplinary proceedings. So when there are a lot of non-compliances found out, non-compliances with respect to accounting standards found, but the auditor's report is clean, whereas it should have been SA 705, the auditor has given it as SA 700, then it will be considered as a breach against the auditor itself. Similarly, although auditors have qualified the report with regards to non-compliance of certain accounting standards, in some other cases we have seen, he said that these accounting standards have not been complied, but he stopped there. The auditor's job does not end by saying these are the non-compliances with respect to accounting standards. They have omitted to report the qualification. In fact, it should not be qualification, quantification of the possible effect, either individually or in aggregate. So the report of the auditor is supposed to pinpoint what is a non-compliance, and also say if that the profit has been affected to the extent of 2 crores on account of this accounting standard not being properly complied. If it were to be properly complied, the profit would have been lower by 2 crores and the inventories would have been lower by 2 crores. So we'll have to say what is the possible impact of that non-compliance very clearly in the qualification. Now, there are certain issues which were asked in one of the sessions that I dealt with in Bangalore. Anant Narayan Pai from Udupi asked this particular question. For determining the status of SMC for an earlier period, whether the new limits to be applied or old limits. Now, if you remember, I said a company could be dropping from a higher level to a lower level. Now look at this. A company was always following 60 crores, turnover was 60 crores. Now it has upped to 250 crores. Now, do I automatically say that should I test this for the last next 2 years and then determine or not? So that is a question. I think the institute only has to answer. But in my opinion, I would say follow the harsher of the recommendations. If you were a level 1 in the last year by virtue of your limit being more than 50 crores, now by virtue of 250 crores you are coming down. You continue with this, the earlier compliances for the next 2 years. So that is my view on the subject. Whether audit report to be issued to general purpose and or tax audit, etc., individuals, HUF, etc., to be modified in the following cases. Entity followed ICDS while preparing the financial statements and not ICAI accounting standards. Well, these are normal mistakes which I have seen by chartered accountants. They say that I am doing my accounts only for income tax purpose. I am giving my report only for the income tax department. So therefore, the company has not followed. The company has complied with ICDS. Please ensure the moment the company has any commercial activity, industrial activity has seen, and you as an auditor are certifying, you have to certify following the standards on auditing. You are doing an attest function. So therefore, if there is no compulsion on the entity to follow accounting standards, like companies accounting standard rules 2021 or 2006, which compels the company to follow section 129, what we said. If the company does not comply with accounting standards, there is a penalty on the company and the officers in default. But in the case of a non-company, if the accounting standard of the Institute of Chartered Accountants of India is not followed, there cannot be a penalty on the preparers, on the partnership firm, or for that matter LLPs, or for that matter proprietary concern. But the auditor who is doing the attest function, he is under a requirement to follow the to report on such non-compliances. He should compel the company, the entity, to follow the accounting standards. Otherwise, he should tell them that I will qualify. So based on this threatening, the company may follow. If they, in spite of the threatening, if they don't follow, the auditor has no option but to qualify it, even if the entity has followed ICDS. Entity follows ICAI's accounting standard with some exceptions, like provision for tax not made, property, plant and equipment disclosed only at net block. Please understand, we are preparing the accounting standard 10, property, plant and equipment is also applicable for non-corporates. One of the disclosure requirements under accounting standard 10 property, plant and equipment is gross block, depreciation, net block, opening balance, accumulated closing balance. So this type of a disclosure is required even for a non-corporate entity, just like in the case of a company. Normally non-corporates would follow the what should I say, the income tax rate of depreciation using the block concept. If they are doing it, the auditor, if he is certifying such financial statements, I am afraid has to bring out that particular qualification, saying that the disclosure as required under when the para number so and so of accounting standard 10 has not been complied with. Similarly, provision for taxes, provision for deferred taxes is applicable for level 1, level 2, level 3. For level 4, if it is not given, no problem. But provision for current tax has to be given by level 4 also. If it is not given, the auditor has to qualify that. And LLP follows MCA accounting standard instead of ICAI accounting standard. You know, all of us know that LLP is covered under the Ministry of Corporate Affairs for the purpose of regulation. But that does not mean that Companies Act applies to LLP. For an LLP, the accounting standards to be followed is the accounting standards as given out by the Institute of Chartered Accountants of India. Whether auditor must give a qualified opinion, if they have followed the MCA accounting standards, in substance, there is no big difference between MCA accounting standards and ICAI accounting standards. But in any case, the nomenclature of the standard that should have been used by such an LLP should have been accounting standards of the Institute of Chartered Accountants of India. If he says that it is MCA accounting standards, I would say you should tell such a person to change it to ICAI accounting standard instead of qualifying. If he, however, persists on following the MCA accounting standards, I'm afraid that you will have to give a qualification saying that there is no quantitative difference between the two. Are there any penal consequences? LLP Act does not prescribe any accounting standard, so there are no penal consequences on the LLP, as I told you. It is only on the chartered accountant. ICAI accounting standard does not have a statutory backing. Then I believe MCA accounting standard is also sufficient compliance. I've also answered that. An LLP, which is a subsidiary of a company, may be following MCA accounting standard or Ind AS. What about LLP then? I have already told you, if an LLP, by virtue of it being a subsidiary of another entity, it has to follow the parent company's applicable framework without thinking of it as a standalone. Any change in view of the LLP is an associate of such a company. Same, the views will not be changed. A cooperative society follows hybrid system of accounting. So what is the which is in accordance with the statute applicable to it? Does it require any disclosure or modification in the audit report? I think we have to follow either a cash system or an accrual system. In fact, a cooperative society does not have a mandate to follow accrual system, unlike in the case of a company. If it follows a hybrid system, you might as well make that particular disclosure in the audit report also. Cooperative bank having 500 crores deposits, advances 320 crores with the interest and other income 64 crores. Clarify whether accounting standard is applicable to cooperative banks. The answer is yes. Which accounting standard? Of the Institute of Chartered Accountants of India, not of MCA or Ind AS. If yes, under which level entity they fall? As we have already seen, public when we see the borrowings here, when we see the borrowings limit here, borrowings including public deposits of more than 50 crores. More than 50 crores. Here the cooperative society has a deposit of more than 50 crores, means 500 crores. So therefore they have to follow the level 1 accounting standards of the institute. Since I am talking about audit, let me close by talking about tax audit also. Tax audit, there has been certain changes. I mean, amendments. When I was talking about amendments, somebody said, are you talking about tax audit also? I said, okay, let me cover one slide on that. On 1st of April 2021, there was a notification which amended the Form 3CD report. Form 3CD report 1, 2, 3, 4, 5 amendments in Form 3CD. One of the amendment is in clause 8A, which amended to comment whether the assessee has opted for taxation under section 115BA, BAA and BAB applicable for corporates who want to take the lower tax regime. 115 BAC is for individuals and HUFs who want to opt for lower tax regime at every 2.5 lakh level of incremental total income. The tax rate changes by 5%. So that is 115 BAC, which is an option given to them to follow a lower tax rate by surrendering lot of deductions and benefits. Most important deductions which they have to surrender is for a businessman, chapter 6A deductions. And for a salaried person, apart from that, he also has to surrender standard deduction or leave travel concessions. So like that, a lot of concessions have to be given up. Then he can come under the lower tax. So as a tax auditor, I have to tell whether he has opted for 115 BAC. 115 BAD is for the lower tax regime with respect to a cooperative society. Clause 17 deals with to include details of transfer of land or building for consideration less than the value referred in 43 CA or 50 C. When all of us are aware, you have to follow the guidance value. However, a discount of 10% is given. So that is already covered in 43 CA, 50 C. What they introduce is for the period from 12th November 2020 to 30th June 2021, if the value of the property, is up to 2 crores, instead of 10% acceptable deviation, they have provided for a 20% acceptable deviation only with respect to, not with respect to capital assets, but with respect to business assets. That means in the case of a builder who is constructing the building for the first time and selling it and offering the taxes under section 43 CA under income from business, and correspondingly on the receiver of such an asset, 56(2)(10) also will be relaxed up to 20%. So that provision has been introduced, and to accommodate such a provision, a column has been inserted in clause 17 to say whether such transfer falls under the 4th proviso to section 56(2)(10) or 2nd proviso to section 43 CA. Now clause 18 to include details of adjustments to return on value. Now we have to note that whenever I am opting for 115 BAC, I have to give up any additional depreciation and unabsorbed additional depreciation on the plant and machinery used in factory. So that for adding it back, they have provided a column under clause number 18. Under clause number 32, if there are any unabsorbed losses on account of things which you cannot claim under 115 BAC, that has to be surrendered. So for that, clause 32 is changed. And clause 36 dealing with the dividend distribution tax paid by a company under section 150, because all of us know that the dividends have got shifted, tax payment on dividends has got shifted from the company to the receiver of dividend. Company earlier was paying DDT, so that has got abolished. So clause 36 accordingly stands omitted. So with that, we come to a question station. We can take 5 or 6 questions before we move to the next.
Selva, you have questions?
I'll just flash the questions.
Yeah.
Pandaraj sir, you have taught me accounting. You are my standard. So any points that you want to add on the accounting standards?
So your flow is so good today. It is enough if one consumes it properly. That's the.
So there seems to be some audio problems, sir, Pandaraj sir. Some audio problem.
I see.
Yeah. Connectivity is there, a little problem there, I think.
Yeah.
Harpe.
Bellary, sir.
Some connectivity issues there. Okay.
Gururaj,
Yeah.
sir,
Sir,
Guru and
Selva is at 12. We had finished till 11th. 11 question.
Yes, sir.
12th.
12th we
Suppose the
can
auditor has the knowledge. Suppose the auditor has the knowledge that audit has not complied with any other act law, say RERA, FEMA, NBFC, can we report under other matters in the independent auditor's report?
No, sir. No, sir. No. Other matter is not a matter like that. I think, George, when you become president of the institute in future, I would recommend that this other matter should be changed as audit matter. I mean, other matter relating to audit. It is not an other matter in that sense. Please understand that can we report under other? All such matters, if they are material, has to be reported under the qualification itself. What you report under emphasis of matter and other matters are not matters which will have a bearing on the which will not be a semblance of a qualification. They cannot be a semblance or a quasi for the qualification. What comes under EOM and other matter paragraph, you as an auditor have nothing, you have not modified your opinion. You don't have anything abnormal about that. You are absolutely satisfied, but you want to point out that matter. But that matter, if it is non-compliance with respect to RERA or FEMA or NBFC, you will have to see whether such a non-compliance would lead to a material penalty or a material cancellation of the license itself. In that context, you will have to bring it as a qualification and not tuck in as another matter under the audit report.
Sir, with your permission, you may also refer essay 250, I think if I remember correctly, consideration of laws and regulations in an audit of financial statements in this context. Whether when provisional financial statements are signed for submission to banks, wouldn't be generated, will the report template be shared?
No, I think I've already discussed that. UDIN has to be generated. Provisional financials, as I just told you, it cannot be a seal and signature on the provisional financials. It has to be covered up by a proper audit report, and that audit report, I've already shown it on the screen, so which is already available. So please follow that.
Sir, can I take 1 minute just to add to that?
Yeah. Yes, please.
Yeah. So this provisional financial statements have been playing around, provisional and projected financial statements. Dear members, please understand that we cannot sign provisional financial statements as sir rightly subject to audit, prepared from the books of accounts. All this is gone. In order to seal, this is set with the purpose SRS 4410. It's a related service. We are doing only a compilation. No audit, the level of assurance is 0. 0 is the level of assurance. So provisional projector should not be signed. If you have a trial balance, basically compile from the books stock reliable statements. Based on that, as sir said, it should be a compilation report in compliance with SRS 4410. Please, and so for God's sake, do not issue provisional and projected financial statements just with the seal and the stamp and the signature. We call it chapa, just a chapa now. Company has defaulted in payment of statutory dues and the default is continuing. Whether this has to be qualified in audit report or put under emphasis of matter paragraph. Again,
see, let us be very clear. Let us be very clear. If the matter is already there as a liability in the balance sheet, there is no need for a second emphasis on that matter unless it is unless it is a matter of a provision. Normally, contingent liabilities are brought out as emphasis of matter. If the liability is already there, you are saying that the liability is already there and the financial statements are true and fair to that extent. You don't have to bring in. But under CARO, they want you to again re-emphasize that matter. Use that CARO reporting as required, but not for the main audit report itself.
If the turnover threshold increased, will IFC applicability also change?
No, sir. For the moment, please understand that the Companies Act has not changed because that particular relaxation of turnover of 50 crores was brought in by a removal of difficulty order. So unless that changes, for the moment, 50 crores applies for IFC determination.
Based on accumulated net worth, if Ind AS is applicable but company is still SMC based on turnover and borrowings, are there any exemptions applicable? It's an interplay.
The answer is no, because if Ind AS is applicable based on the accumulated net worth, if Ind AS is applicable, then Ind AS has to be followed and not the accounting standard itself.
Great, sir. These limits apply for cutoff.
I think let us look at like this. Let us look at like this. Schedule 3. Let us say Schedule 3 division. Schedule 3 goes on to define to whom what is applicable. Companies Act goes on to define what is applicable to whom. So Schedule 3 very clearly says based on your net worth of 250 crores and above, Ind AS is applicable. So you have to go in for Ind AS. If your net worth is less than 250 crores or you're not listed and therefore Division 1 is applicable, once you come to Division 1, then you go to accounting standards, and based on that accounting standards, based on the rules, you will see whether you come as an SMC or non-SMC. Once Ind AS is applicable, you follow Ind AS.
These limits apply for cutoff date of year end, or if during the year if the borrowings breach the limits, then how to treat for classification?
No,
I
I
think,
told
sir,
you,
this is regarding the
as far as the turnover is concerned, it is for the year. As far as the borrowing is concerned, if somebody very intelligently ensures that the borrowing is zero at the year end, but it was there at some point in time. So borrowings ke liye the criteria have to be checked this any time during the year. Anytime during the year.
But the standards applicable to non-corporate entities need to be complied for the entities audited under 44 AB of the Income Tax Act, which is not required to be audited under any other act. Yes.
Let us be very, very clear. Our institute guidance note on accounting, guidance note on tax audit very clearly says that we have done the audit as per standards on auditing. That is where I always ask a question for tax audit. We give a true and correct as our opinion, as opposed to fair and lovely for accounting standards.
This is accounting standards he's asking, sir.
As against true and fair. No, I'm just saying, we say true and fair as far as accounting standards are concerned or a company's accounts are concerned, but when it comes to tax audit, we are saying true and correct. Does that mean that true and correct is superior to true and fair? Maybe yes, but then our institute is saying even in the case of true and correct, it is not an absolute assurance, just like in the case of a certification. Because if you say it is true and correct, the department, there is an expectation that it is actually an absolute assurance. But we have to tell the department also that it is a reasonable assurance considering the inherent risk that is present in the case of an audit. An audit is not an investigation at all. Very beautifully, the chairman of Deloitte, Mr. P.R. Ramesh, the past chairman, he was very beautifully telling an audit report is like a thermometer. I like that particular catch. It can detect sickness. It cannot detect cancer. Beautiful. You know, an audit report is like a thermometer which can detect the sickness that is there in the company, but it cannot detect a serious illness, you know, like cancer. For that you will have to go in for a further investigation, etc. Having said that,
it's not a CT scanner.
Yeah, it is not a CT scanner in that sense. It is a thermometer. Having said, although you look at this from the regulatory perspective, they think that it is a CT scanner, a PET scanner, and all the scanners. You know, that is there. So that to bridge that particular expectation and tell them, hey, you don't, true and correct does not mean that I have done an absolute assurance. I'm giving you an absolute assurance. I'm giving a reasonable assurance. I have done my audit based on standards on auditing, and therefore, although the Form 3CA or 3CB does not carry all these words, our institute in the guidance note say that under clause 3 of Form 3CA or under clause 5 of Form 3CB, you tuck in the SA 700 wordings, and those wordings are given in the guidance note on tax audit report issued by the Institute of Chartered Accountants of India, wherein they have said whose responsibility it is to prepare the tax audit report. It is the responsibility of the assessee to prepare the Form 3CD. And then I will say my responsibility is to verify this considering the standards on auditing. When I say standards on auditing, I may adopt sampling. I may adopt, even for 40A3, I may adopt sampling and things like that, because standards on auditing permits. So that can be done only if I explicitly say that I have complied with the standards on auditing. So the short answer to the question is that even for tax audits, I have to follow standards on auditing.
Sir, whether AS is applicable for trusts and societies? No, because no P&L is prepared.
You may not prepare a profit and loss account. You may prepare an income and expenditure account. But if such an income and expenditure account has any element of commercial activity or industrial activity, then I'm afraid, even though you call it as income and expenditure, you will be required to comply with the accounting standards.
Selva, please go down. Just now you told sale of vehicle is ordinary course of business for my question, but it is not as per company MOA and not for client furtherance of business and transactions related party without arm's length basis. Then can we justify that it is not attractive?
Although I was expecting this counter question from the gentleman who asked this, because there can be an element to say sale of vehicles is not in the ordinary course of business. But there has been opinion. So when in doubt, I always say take it as a challenge and then you do it. But the auditor challenges it and the company says it is in the ordinary course of business. So that is where it comes in. So these are all incidental to the carrying out of the operations of the company, and hence certain authorities take it as in the normal course of business. So that is the answer to this. I expected this from the gentleman who asked this. I'm sure he would have had a head-on with the client who would say that it is in the ordinary course of business, and he would have opined that it is not in the ordinary course of business.
Yeah, replacement of assets I think should be ordinary course of business only, because you cannot keep all the aging assets like that. So many a firm are not paying correct percentage of salary towards PF. Is it the auditor's responsibility to report any such deficiency in payment of PF contribution?
Now, if they are not actually calculating, then I'm afraid you will have to calculate a provision for that. You will have to calculate a provision for not paying the correct PF. If such a provision is not there, I'm afraid you have to qualify if it is material.
In case when auditor is satisfied with the explanation of management that the company will be able to sustain in future, should we give a qualified opinion with material uncertainty para, or it should be an unqualified opinion? And is it permitted to include uncertainty para in?
Now, if the auditor is convinced that the future is going to be taken care of, although there is an uncertainty now, the auditor must be satisfied, and satisfaction is not tikaya tu karega. It should be based on anybody. That's what we keep telling. It should be based on some convincing evidence, like a letter of guarantee given by the holding company or the net worth support of the promoters, and then a letter of support from the promoters. Then we can say that although the net worth is negative, the current ratio is less than 1, things like that, still the company will be able to carry on its activity in the future because of this particular support, and that has to be mentioned under that material uncertainty paragraph in the audit report.
Is IFC exemption limit to be checked every year, or is it once is always?
No. Every year.
Then one of the conditions in that IFC exemption is the compliance with 92 and 137, filing of it to be compliant fully. So can the company, there has been some problem, can the company file the returns, come clean and say that now you exempt me from IFC?
Sorry, I'm not able to hear you. I'm reading it. Can they get the exemption subsequent to that after complying with one? Yes, I think yes, because they are talking about default at the time of filing. That is how we are interpreting. Now, if they have overcome that particular defect, the defect no longer continues, and therefore, if the other criteria are complied with, IFC can be avoided.
Is an LLP compulsorily required to comply with Schedule 2 on calculating depreciation? Please understand,
LLP Act is different from Companies Act. Companies Act Schedule 2 talks about depreciation for companies. Therefore, LLP is under no obligation to comply with any of the schedule, or for that matter, any of the section of Companies Act. However, LLP has to therefore now come under Accounting Standard 10, useful life of the asset, and provide depreciation as per Accounting Standard 10.
Sir, if I may just add, Schedule 2 gives only indicative useful life. So even a company is not in strict requirement to comply with AS2, Schedule 2. It can resort to different rates based on technical evaluation and things like that. As there is no legal obligation. Yeah, sorry, with the due disclosure. In fact, Infosys 2 years back, they had given a brilliant disclosure, textbook case they had given, because they had resorted or adopted a rate which is different from this particular Schedule 2 rate, the years. As there is no legal obligation for non-corporates to comply with AS, if they refuse to follow, should we give disclaimer or adverse opinion?
I don't think you should give a disclaimer or an adverse opinion. You can give a qualification. You can give a qualification, but then if that qualification, like from AS1 to AS29, AS1 to AS29 has not been complied, and you are not able to quantify any of the quantify the impact of that, then I am afraid you will have to disclaim only. You will have to give a disclaimer rather than giving a qualification. Absolutely right. Yeah. Shall we
So we
proceed,
have
sir?
finished all the questions there. Sir, please move on. Back to you.
Yeah. So we go to the amendments in Schedule 3 and CARO. Let me just warn before I get into this territory. I already told you that this amendments in Schedule 3 has come in by virtue of a notification. Dated dated 24th of March 2021. This is a very red letter day. Two dates we'll have to remember always. 22nd January 2021 for CSR, 22nd January 2021, and 24th March 2021 for all the changes in the books of accounts, audit report format, board reports format, and Schedule 3 presentation itself. Schedule 3 format itself. You are able to see me, right? I mean, it's saying something. Okay.
Yes, sir. We can see you and the screen is visible.
Okay. Okay. So amendments to provisions. So we have changed the four formats. So let us see what are these four changes and from when it is applicable. It went on to say that these changes are applicable. These changes are notification mentions effective date as first day of April 2021. It is effective from first day of April 2021. That led us to the confusion whether it is for all the financial statements signed after 1st April 21 or financial statements commencing from 1st April 21. In fact, Manara sir, you will be aware that under the 1956 Act, when Schedule 6 was there, Schedule 3 was equivalently called as Schedule 6. Okay.
Is there any problem?
Yeah, I mean, I'm not able to see Jemo. That's the issue that I was talking about.
Jovan sir has stopped his camera. Maybe I request him to turn it on. He turned off his camera, sir. 1 minute.
Yeah, he has switched on his camera. Okay. Okay. So what I was trying to say is, notification mentions effective date of 1st April. Under the 1956 Act, in 2011, there was a change of Schedule 6 in a big way. Schedule 6 changed in a big way. Earlier we could prepare it under vertical form and horizontal form. Then they said that only vertical form has to be followed. For the first time, we got a format for profit and loss account. A lot of changes happened for the first time in 2011. There, if you read that particular notification on Schedule 6, they said the revised Schedule 6 will be applicable for all those financial statements commencing from 1/4/2011. But in 10 years, you look at the degeneration of the way in which the circulars are given. They just say notification mentions effective date as 1st April. So we had to scratch our head to understand and go to so many pillar to post to find out, because we had to sign the balance sheets on 7th of April, 10th of April, whether we have to follow the revised Schedule 3 or the old Schedule 3. Then we got an answer unofficially from the Ministry of Corporate Affairs, and the institute also, CLCGS committee checked up and gave us a dictum saying that it is applicable for financial statements commencing from 1/4/2021. So in short, for 2021, what is applicable is the old Schedule 3 itself. But as I already told you, please ensure that when you are doing the audit for 2021, you collect all the information that is required for the new Schedule 3, so that the new Schedule 3 next year, when you are giving the comparative information, that will come in handy. And this new Schedule 3 is applicable to all companies, unlike CARO. For CARO, there is a relaxation for small companies and for certain category of companies, private limited companies. But when it comes to Schedule 3, it is applicable for every company. So applicability of CARO 2016 is for the movement in vogue. 2020 CARO was issued on 25th of February 2020. Financial year 21-22 onwards, it is applicable. It has got 20 clauses. Now, to whom is it applicable? Both CARO 2020 and CARO 2016, as it is applicable now, is applicable to every company for the financial year commencing on or after 1/4/21, on or after 21. For audit of the previous financial year, the respective CARO shall apply. For audit, the respective CARO will be applicable. Let us say next year I am doing the audit of 1920 or 2021 for whatever reason. For that, CARO 2020 will not be applicable. So you'll have to look into that particular year what was applicable, and you have to give the report in that particular year's requirement only. It is CARO will be applicable to foreign company, government company branch audits, except for banking company, insurance company, a Section 8 company, a 1% company, and a small company. For a small company, which is defined as under the Act as a company with a paid up capital of less than 50 lakhs and less than 2 crores up to 1/4/21. From 1/4/21, it has been increased to paid up capital of 2 crores and turnover of 20 crores. But for the financial year 2021, you will go with the old definition of paid up capital of 2 crores and turnover of 2 crores, paid up capital of 50 lakhs and turnover of 2 crores as the criteria. The revised criteria will be applicable for financial year 21-22 for small company definition. So, and then it says for a private company having paid up capital and reserves and surplus of less than 1 crore and outstanding loans from banks or financial institution less than 1 crore, total revenue of less than 10 crores, all three of them put together, any one of them breaching, you don't get the exemption. If you are a private limited company with all the three following conditions complied with, then you will be exempt from CARO. But the very interesting thing is, once you are a small company, even if there is a breach in any one of them, you still enjoy the exemption for CARO. So the answer that we see is, first, are you a company where the exemptions are available to generally like banking, Section 8 company, then you don't have to prepare. But are you a public limited company or a private limited company? Once you're a public limited company, you see whether you're a banking company, insurance, Section 8 company, or then you exempt, otherwise you have to follow. For a private limited company, I will see whether you are a small company or other than a small company. If you are a small company, you are exempt from preparing CARO. If you are an other than small company, a private limited company, other than small company, I will go to test the other three conditions. If these three conditions are complied with, then I don't have to prepare a CARO. Otherwise, I will have to prepare CARO report. So that is how we'll have to see. Now I come to the substantive provisions of CARO 16 vis-a-vis CARO 2020 vis-a-vis Schedule 3. Schedule 3. So that is the highlight of today's discussion. I had to build up all the case to reach this particular pinnacle. And then, of course, Schedule 3, what are the changes we will see. CARO 2016, and if something is underlined in this particular slide, then that is a new entry. That is a new entry which has come in by virtue of 2020. And if something is in red, then that is an entry which has come in also in Schedule 3. In fact, the Schedule 3 amendments, we should say as auditors, has come in as a blessing in disguise for auditors. Why do I say this? There were a lot of things which were asked in CARO 2020 to the auditor without that question being asked to the preparers of the financial statements in the beginning. I mean, that was a very, very sorry state that I had to opine. Let us say I had to opine on whether the company is capable of meeting its liability in the next 1 year. I mean, that is a point number 9 below. Ability of the company to meet liabilities in the next 1 year. What was the basis for me to tell this? Based on the financial ratios, based on the so many assertions that the company makes. I had to tell whether the company is in a position to meet its financial liability in the next 1 year. Who had to prepare these ratios? I only as auditor had to prepare a ratios. Now Schedule 3 says you will have to give about 11 ratios. You will have to give about 11 ratios in the financial statements, which forms the basis for me to answer this question on ability of the company to meet its liability in the next 1 year. Similarly, there were a lot of questions which were asked on the auditor without there being a responsibility on the preparers of Schedule 3. So now Schedule 3 has got in about 25 new disclosures. 25 new disclosures. I mean, one of the things which I will consider for the ability of the company to meet its liability in the next 1 year is the aging analysis. The aging analysis of debtors and creditors put into proper buckets In earlier debtors was less than 6 months, more than 6 months. Now they say less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Similarly, trade payables are also asked up to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. So these bucketings will help me in finding out whether the company is in a position to meet its liability as and when it is due. This will enable me to answer it very confidently. So those aging analysis, those ratio analysis are all asked for the company now. Once the company does that, I as an auditor can probably, with the help of the information that is already available in Schedule 3, be able to give confidently the answers for this. So I will now cover each one of these aspects. If you look into this, there are about 15 sections. That is, there are 2 sections, I would say, section 1, section 2. Section 1 of CARO 16 or CARO 20 deals with the Companies Act compliances, and section 2 deals with, section 2 in this my PowerPoint slide deals with other than company law matters. So I will now restrict myself first to company law matters. Section 185, 186, it has been there for a long time, continues. What is 185? I mean, I'm not getting into the details of 185, but today I'll just tell you what is. There has been an amendment, because when you're talking about amendments, of course, whatever was there in 2020 audit will continue for 21 audit, but one should be aware of the changes or the compliance as such. So that's why I'm talking about what is section 185. Section 185 says loans to directors, etc., are restricted. Loans to directors, a company, look at this, a company cannot take money and give it to people who are in charge of running that particular company. The people who are in charge of running that company are the directors. So a company cannot give loans to directors. Now earlier the loans could not have been given to companies in which the directors are interested also. But Companies Amendment Act 2017, for the purpose of ease of doing business, they have liberalized section 185 restriction to say that yes, to directors and to the relatives of directors and to the partnership firms in which the directors are interested, or the partnership firms in which the relatives of directors are there as partners or relatives, to that entity you cannot give loans at all. However, there are exceptions to this general rule. For private limited companies, there is a removal of difficulty order given in 5th of June 2015. The question that keeps coming us, because a private limited company, they say relaxation for 185, provided no shareholder of the company is a company. The shareholder should not be a company. There should be no default in borrowings, and the borrowings from banks, financial institutions, and body corporates should be less than 50 crores. And there is a ratio in which the borrowing to paid up capital should be less than 2. If that is done, section 185 is relaxed as far as the private limited company is concerned. But the normal question that comes out is Companies Amendment Act. Okay, I'm still Jeman K. George, are you there? I'm still somehow not able to see you. I wish I could see you. Okay, so although Companies Amendment Act 185 got amended in 2017, and this particular notification, the removal of difficulty order notification, came in June 2015. The question that case is, even after the amendment, will the 2015 relaxation be available to a private limited company? My answer is yes, because the relaxation was in relation to 185, and 185 has got changed. I mean, let us say if 185 had become 185A, like in Income Tax Act, something goes off and something new comes in. Section 12A goes and section 12AA of the Income Tax Act has come in. So section 185 goes and section 185A new has come in. Then that particular relaxation was applicable to 185 and not to 185A. But today, that particular relaxation was given to 185, and 185 contents have got changed. So therefore, the relaxation that is available to a private limited company by virtue of 2015 circular still holds good even for the new 185 restriction. What is the new 185 restriction? For directors you cannot give, but to companies in which the directors are interested. Companies in which directors are interested, earlier you could not give, but in 2017 amendment, they said you can give, provided such a company in turn uses it for its principal business activity, and the company passes a special resolution. Even this is not applicable. There are certain relaxations further for a subsidiary and a wholly owned subsidiary. Special resolution is also not required. Please look into 185 on that particular aspect. What is 186? 186 is not restricting. I mean, it says loans, investments, guarantees, and securities given to anybody, including 185 cases, cannot breach a particular limit. What is that limit? They say that 60% of the paid up capital plus free reserves or 100% of free reserves, whichever is higher. That is the limit. If for whatever reason you are breaching that particular limit, then you shall take the approval from the special resolution. So that is what is 186. So 185 restricting the loans to directors, 186 fixing a limit up to which loans, including loans to directors, can be given. So beyond that, you should take the permission of the company in the general meeting, and then you can go ahead. One more thing very interestingly which is told in 186 is you shall charge interest on loans covered under this section. Now, normally the people that they keep coming to me, should every loan that is given by a company be subject to interest as told under 186 subsection 4 or 5? Then the answer that I give is, it very clearly says that the loans covered under this section, that means up to the limit which is not covered under 186, the directors are at liberty to give the loans under section 179 of the Companies Act. Beyond that particular limit, the directors cannot give. It has to come to the board, general meeting for permission. Now, once the general meeting permits, such a loan shall be carrying an interest as told under 186. So for all loans, interest need not necessarily be charged. However, if the company takes a loan, pays interest and gives a loan without charging interest, please note that such a loan will be prejudicial to the interest of the company, which has to be reported under CARO provision. Yes, please. Yeah. Details of such amounts to an entity, particularly to related party under section 2 subsection 76. In fact, CARO 2016 wanted us to comment only 185, 186 cases, but CARO 2020 wants us to give details of such amounts to any entity and particularly to related party under 2 subsection 76. To any entity, whether loans are given and whether they are prejudicial is what has to be told under the new CARO 2020. Section 73 to 76 are very, very dangerous chapter on deposits. We have dealt with in several cases. Deposits can be exempted deposits or deposits in the true sense of the term. If it is exempted deposit, Rule 2(1)(c) talks about what are all the exempted deposits. Let me quickly take you through what I am talking about. Acceptance of deposits, money receipts can be either not deposits, which I call it as exempted deposits or green deposits, or it could be taken as deposits itself. Now, failing which, if you don't comply with the exempted deposit rules or the deposit complying the rules, then the money taken can be considered as red deposit, which will lead to a contravention and a penalty of 1 crore to 10 crores, or for officers in default of 25 lakhs to 2 crores plus 7 years imprisonment. So that is the seriousness with which we have to approach. And if it is a deposit, let me see what are the exempted deposits. There are about 18 exempted deposits. Popularly among them are money taken from any foreign entity subject to FEMA compliance, loans taken from banks, loans facilities from public financial institutions, commercial papers, loans taken from any other companies, security application money. Money is brought in as share application money. Up to 60 days they are exempt. Beyond 60 days, if they are not allotted, in the next 15 days you have to return them. Otherwise, they will be defaulted. I mean, I would say, what is the word used? Contravening deposits ab initio. Now, very important, any money which is collected, any money which is collected will be deposit unless it fits into the green channel. Now, one of the thing that is exempt is any money which is brought in by the directors is exempt. And in the case of a private limited companies, not only directors, but also relatives of directors are also exempt. Since Madam Revati Raghunathan talked about relatives, Madam, I wish I could see you on the screen, but I should make them a presenter. Selvam, do I have to make them a presenter? Are you sure?
She is driving home.
No, I am present. I'm sitting in the car, so I had put mine on mute.
She is in Alwarpet now.
Yeah. Can I make them a presenter or what?
No, I am present. I am present, sir. I am very much listening to you.
Okay.
The only thing is, yeah.
Okay. So, Madam Revati, madam, you said that relatives definition you like. Let me reproduce the relatives definition. The relatives does not mean any relative. Relative as defined under section 2 subsection 41 of the Companies Act only is relatives. So there the definition of relative is aju baju, aage piche, just upar, just niche. I mean, if I say aage, aju baju, husband and wife, aage piche, brother and sister, upar niche means income tax definition of relative, which is actually going into linearly ascendant and linearly descendant. That is the definition of relatives in income tax for the purpose of 40A, 2B, etc., etc. When it comes to definition of relatives for the purpose of Companies Act, especially for this definition, in fact, there is no other relative definition in the Companies Act. Companies Act relatives are only one. In income tax, we find relatives definition in 3 places. I'm not talking about that. For 56(2)(10), there is one relative. For trusts, section 13, there is one relative, and the general relatives as defined in section 2. When it comes to Companies Act, definition of relatives aju baju, that is husband and wife, aage piche, that is brother and sister. It is not upar niche. Like in income tax, upar niche means linearly ascendant and linearly descendant. But for the purpose of Companies Act, it is just upar, just niche. That is father and mother, son and daughter. So please understand, for Companies Act purposes, if I have taken a deposit from my grandfather, the relative of a director, I am a director and I have taken it from my grandfather, then that will not be considered as exempt deposit because my grandfather is not a relative under the Companies Act. Only my father and mother, son and daughter. Because my grandfather and grandchildren are not my relative, they introduced 2 more definition of relatives in Companies Act. One is son's wife and the other one is daughter's husband. So son-in-law, I mean, I always ask this question, son in which law? You will have to say son in company law. So daughter-in-law, daughter in company law. So for the purpose of Companies Act, definition of relatives, aju baju, aage piche, just upar, just niche, son's wife and daughter's husband. So that is the definition of relatives you can take. But when you are taking it from a directive or from a relative of a director, which is allowed only for private limited companies, not for public limited companies, I am afraid that they have to give a declaration. What is the declaration? That it is not brought in from borrowed funds. It is not brought in from borrowed funds. Then say issue of secured debentures or compulsorily convertible debentures subject to certain conditions. Issue of unsecured listed non-convertible debentures subject to SEBI regulations. Then any amount brought in by an employee up to 1 year salary. Then any amount brought in as non-interest bearing amount and held in trust. You know, non-interest bearing, I would not like to get into explanation of each one of them separately. I have already done this in SIRC some other time. So non-interest bearing amount and held in trust. Unsecured loans from promoters, if and only if stipulated by the banks. If they have told that the promoters have to bring in the money, then although it is out of borrowed funds, they can bring in. But the point to be noted is once the bank's loan is returned, it goes out of this 13th column. So that is a point to be noted. If they continue to be directors, then there is no problem. To that extent, they have to give a declaration. So 14th point, accepted by Nidhi companies. 12th point, of course, is any amount received in the course of or for the purpose of business of the company as advance from customers up to 365 days. Beyond 365 days, if you have taken from advance from customers, it will be a regular deposit. Please understand. Advance for immovable property, no period involved. Security deposit under contracts. Advance for long-term projects. Advance for future services. Advance received and allowed by sectorial regulators. Advance for subscription towards publications. CHIT subscription as per CHIT fund collective investment scheme, more than rupees 25 lakhs collected in a single tranche by a startup as convertible notes, convertible to equity shares or repayable within earlier it was 5 years, and 7 September they made it 10 years. Alternative investment funds, etc. So why did I carry is, if you are coming under green deposit, there is no problem. But if you are coming under blue deposits, that is, you have to comply with the deposit rules. Then in that context, you can take it from non-members or from members. You can take it from non-members only by eligible public limited companies whose net worth is more than 100 crores or turnover is more than 500 crores. I'm not going to talk about them. From members, you can collect it. Members means deposits can be taken from shareholders. Directors, we have seen it is exempt. subject to declaration. Members, that means shareholders, I can take by a public limited company up to 35% of my net worth. Here net worth it means only paid up capital plus free reserves plus share premium account. The question I would like to ask always is whether free reserves includes accumulated profits. Jaman Kejaj, are you there? Whether free reserves includes Pandara sir, if you are there, I think you can also unmute and answer this question. Whether free reserves includes accumulated profits. Yeah, since I don't hear from them, I will proceed. The answer to this is very interesting. Free reserves, please understand, does not include accumulated profits. Free reserves are, that is why I use the word reserves and surplus. That means reserves are different from surplus. Surplus is covered under accumulated profits, but reserves are different. So reserves, so here that is why I had to say net worth means net worth is equal to paid up capital plus free reserves plus security premium account. Don't include your accumulated surplus while calculating the 35% limit, or in the case of a private limited company, it can borrow up to 100% of the net worth without considering these free reserve, I mean accumulated profits, or any amount. If it is any amount, then there are certain additional conditions that they have to comply with, that they should not be an associate or a subsidiary of any company. Their borrowings from banks, financial institutions and body corporates should be less than 50 crores, and BFC divided by paid up capital should be less than 2, or no default in repayment of such borrowings. And for a startup, they have given a very beautiful exemption. Any amount by an eligible startup up to 10 years from the date of incorporation, they can borrow any amount. So that is the benefit available to a startup in that sense. So 73 to 76 we have seen. 148, maintenance of cost records by certain companies. Not all companies have to maintain cost records. For companies engaged in production of goods, providing of services, 6 regulated but plus 33 non-regulated sectors. They have told what are the regulated and what are the non-regulated, only those cases. Then there are certain turnovers which you will have to comply with. Section 42 and 62, allotment of preferential allotment or private placement of shares or convertible debentures, compliances whether it is properly done. Section 197, now please understand, 197 is managerial remuneration ceiling, not applicable to private limited companies. Now this point has been deleted in CARO 2020, CARO 2016 it is there, but in CARO 2020 it is deleted. Why is it deleted? Because section 197 now wants every public limited company to give in the main audit report itself, whether the ceiling of managerial remuneration is within the ceiling or beyond the ceiling. Even if it is within the ceiling or beyond the ceiling, that point has to be covered in the main audit report, and therefore in CARO it was a duplication which has been avoided. So to put it in other words, in the financial year 2021, for a public limited company, the managerial remuneration aspect will get covered in the main audit report once and in CARO 2016 once more. But from next year onwards, it will be there only in the main audit report and not in the CARO report. Section 177 and 188 dealing with related party transactions. So I am not getting into the details of it. 177 is audit committee. Wherever there is an audit committee, it has to go through the audit committee. 188 deals with related party transactions. Who are related party defined in section 2 subsection 76? There are 9 types of related parties. I'm not talking about that. But what are the type of transactions? Every transaction with a related party is not a related party transaction. They have defined about 7 types of related party transactions. I remember last year I have spoken only on related party transactions, and it's still available in the SIRC website when Dungarchand was the chairman. I have spoken about this, comparing it with accounting standard 18, deposits, etc. in detail. So on a Sunday, I don't remember the date. Please go back and check up the details. You can find it out there. So in short, related party transactions can be very beautifully if the related party transactions are entered with. Okay, let me just put up one slide to make things clearer. Company entered into a contract or arrangement with the related party. Not every party is a related party. They have defined who the related party is. They have defined 9 types of related parties. Check that. This is also applicable to companies, including private limited companies. And if the answer is yes, we'll have to just ask the next question, whether it is in the ordinary course of business and at arm's length. That is why my friend who asked that particular question, whether selling of vehicles by let us say a garment manufacturer is done in the ordinary course of business. There have been different opinions, but the opinion which I have taken is it is in the ordinary course of business. Thus, plus whether it is at arm's length. If it is at the ordinary course of business and at arm's length, then no action is required under section 188, but disclose in the director's report. But if any one of them is breaching, that is, it is not either not in the ordinary course of business or it is not at arm's length being in the ordinary course of business, then we'll have to see whether it is a related party transaction as stipulated. They have stipulated 7 types. Well, one of them is sale and purchase of goods, sale and purchase of property, leasing of the property, availing or rendering of services, agency business, office of profit, or underwriting. 7 types of transactions they have stipulated. Let us say loans to directors, remuneration to directors is not covered under 188. That's what I wanted to tell you. Because loans to directors are covered under 185. Remuneration to directors is covered under 197. So only type of transactions told here are covered under 188. Now then, if it is not a related party transaction, no action required under 188. Check other actions required, if any. But now, then they have told breach, whether the limits have breached. What is the limit? They are generally told, earlier it was linked to some values. Now they said 10% is the limit. When for my easier understanding, let me just tell you, 10% means 10%. If it is a profit and loss account item, it is linked to 10% of the turnover. If it is a balance sheet item, then it is linked up to 10% of the net worth. Easier for understanding. So sale and purchase of goods, or lease of property, which is lease of a property means it's not a balance sheet item. It will avail in what should I say? It will entail rent receipt or rent payment. Therefore, it is a profit and loss account item. Availing and rendering of service, again a profit and loss account item. So therefore, there they say the breach is 10% of your turnover. If the limit has crossed more than 10% of the turnover, then you have to go with board consent plus prior ordinary resolution. If it is within that, then a simple board consent is sufficient. Then there are other provisions one has to comply with. So going back to 188, 177, 192, non-cash transactions with directors or persons connected with them, 143.12, fraud reporting, 135. Yes, let me spend some time here. CSR. Under the CARO 2020, CSR has to be specifically reported by the auditor. But for now, the auditor will not have to report, but the company has to ensure compliance with the revised section 135, subsection 5 and subsection 6, which got instated or which got live on 22nd of January 2021. So what is this new provision? All these days, a company which was required to spend on CSR had to spend or report that I have not spent. How much they have to spend, we all know, 2% of the average profit of the last 3 years. No, I should have spent. Who had to spend? Any company, including a private limited company, if its profit before tax was more than 5 crores, if their turnover was more than 1,000 crores, or their net worth was more than 500 crores. So they had to spend 2% of the average. So that was all clear. If they did not spend, what they should have done, they should have reported it in the board report saying that we have not spent and give the reasons why they have not spent. That's it. That was compliance with 135. Now on 22nd January 2021, they said that if for whatever reason you have not spent the amount required, 1 crore was required to be spent, you have spent only 70 lakhs by the end of the year, then this 30 lakhs, you have been given 2 options. Option number 1, you have to say whether you have an ongoing project against which you will spend. If you say that you have an ongoing project, then within 30 days, that is 31st March means within 30th April, you shall put this 30 lakhs in a separate bank account and spend it against this ongoing project in the next 3 years. Failing which, you shall deposit this money into a specified fund account. Fund specified under Schedule 7 itself, maybe PM Cares account or a Prime Minister's National Relief Fund or whatever fund which is Ganga Project Fund, whatever funds that is told in Schedule 7, or an unspent CSR fund account they have created specifically for that. You transfer that money within 30 days from the end of 3 years. So that is for ongoing project. If you say that I don't have an ongoing project, then within 6 months, within 6 months from the end of the year, that is from 31st September, January, 31st March, 6 months is 30th September. Within 30th September, you shall deposit this money in the fund account as we just now discussed. So that is 135.5. Unspent amount to specified account under 135.5 within 30th September. Or if you have an ongoing project, then a special account to be opened with the bank within 30 days, that is 30th April, and put it there. And within 3 years you spend. If you don't spend within 30 days from the end of 3 years, you have to comply with the requirement. Now this CSR, which is in red, there are disclosures required under Schedule 3 revised. Now Caro, other reporting points I am not going to deal with today because it does not involve any change. Property, plant and equipment, proper records for intangible assets also under Caro 2020. Physically verified by the management, accounted for discrepancies. Title deeds of immovable property in the company name. This is already there. Details of revaluation. In fact, this I forgot to put it. This title deeds of immovable property in the company name has now been introduced in the revised Schedule 3 also, which is effective from next year. Details of revaluation, proceedings under the Benami Act. Both of them coming next year, but proceedings under Benami Act also to be covered under Schedule 3 revised. Point number 2 on inventory, physically verified by the management and accounting for discrepancies. Most important thing why I wanted to talk today is, what I wanted to talk about is agreement with the books of quarterly returns filed with the banks. Agreement with books of quarterly returns filed with the banks. Please tell all your clients, although this is applicable from next year, and also this will also have to be, what should I say, given as a disclosure in Schedule 3. What is the disclosure? The companies have to say, companies which have borrowed more than 5 crores from any bank will have to submit along with their monthly stock statements a quarterly financial system, quarterly information system. That quarterly information system will have to be in agreement with the books as drawn out on the quarterly. Now, as on 30th June 2021, if our, let us say, companies give some quarterly information system. Quarterly information system consists of what is the turnover, what is the expenditure, what is the debtors, what is the creditors. In short, it is a quarterly financial statement itself. If that particular financial statements is not in agreement with the books, let us say some of the companies, for the sake of getting a higher drawing power or to show a better result, so that they have already drawn funds or they want to draw more funds, they have actually maybe mischievously given a higher figure to the bank on a quarterly. It will all have to be reported by the auditor in his Caro and by the company itself in the revised Schedule 3. So what I want you to do is, please inform your clients that all their quarterly information system which goes from the to the bank every quarter should be from the books of accounts, so that when you actually draw out in hindsight, it should all be in agreement, so that there will be no adverse recording. So unrecorded income disclosed to IT assessment, statutory dues, repayment of defaults, application of funds raised by IPO, FPO, Nidhi company, registration under 45(1)(a) of the RBI Act. Most importantly, some of the companies will not be complying with this. A company can need to be registered under 45(1)(a) if it is an NBFC, or it is a deemed NBFC. What is a deemed NBFC? Let us try to understand. A deemed NBFC is one which passes the 50-50 test. Now, what is the 50-50 test? If more than 50% of the total assets in the balance sheet comprises of financial assets. Financial assets means investment, shares, debentures, excluding bank fixed deposits, and more than 50% of the revenue is from income on account of such financial assets, that is by virtue of dividends or interest or profit on sale of investments, etc., then you are deemed to be an NBFC. You are deemed to be an NBFC, and a deemed NBFC is required to take a registration under 45(1)(a). This is the obligation on the company. As far as the auditor is concerned, he has to report whether the company is required to take a registration, and if a company is required and it has not taken, he has to report it adversely in the Caro and also inform the Reserve Bank of India that this company has actually not complied with the registration. These are the dual obligation for a auditor, which I wanted to tell. The ability of the company to meet the liability in the next 1 year, we discussed this. Very difficult for the auditor. He has to be an astrologer to answer this particular question. Then statutory auditor resignation. is a matter which is to be covered under CARO 2020. Consider issues, objections or concerns raised by the outgoing auditors, internal audit systems and cash losses. These are all new things which have been introduced by CARO 2020. So let me just now go in a very fast pace in the next 5 minutes and try to cover up. I think there are a lot of things to cover, but in any case, I'll try to respect the time. Gist of amendments, wide notification, MCA notification, accounting software, create audit trail that cannot be disabled. Was originally required from 1/4/21, but then finally moved up to 1/4/22. Ensure that from next year, such a audit software is built in. The reason for that is very interesting. Quarterly financial statements, if some company mischievously prepares a financial statement, matches it and goes back and changes it afterwards, there should be an audit trail to find out if there is any mischief conducted. That could be one of the reasons, in my opinion. Schedule 3, I told you 25 additional requirements, 10 changes in nomenclatures. Most prominent amounts, though 25 I have told you, aging of trade receivables, trade payables also, capital work in progress and intangible assets under development, 11 ratios with numerator and denominator. If deviation from the last year is more than 25%, give reasons. Mandatory rounding off. Today rounding off is mandatory only in Ind AS balance sheets, but in the regular balance sheets also, rounding off is made mandatory from next year onwards to the nearest hundreds, thousands, lakhs, depending on whether your turnover is more than 100 crores or less than 100 crores. They have two different criteria. Details of Benami property, conduit lending. If I have given to, I could not have given it to my related parties for whatever reason, I therefore give it to X and ask that X to give it to my related party. So that is called as conduit lending. As a reporting on that, not only by the company, but also under the auditor, you will see that that reporting is required. Proceedings under the Benami Act. Relationship with stuck-off companies. Details of title deeds of land and building not held in the name of the company. Loans or advances in the nature of loans granted to promoters, directors, KMPs and related parties. CSR details. Shareholding pattern of promoters. Whether details provided in quarterly information system are in agreement with the books, if not reconciled with the reason. Details of charges or satisfaction of charges pending with reason. Very important. Charges and satisfaction of charges has to be done in a time-bound manner, especially creation of charge. You can do it within 30 days by paying normal fees, 30 to 60 days by paying additional fees, 60 to 120 days by paying additional fee plus ad valorem fee. Beyond 120 days, you cannot file the CHG1 and the charge holder will be considered as an unsecured charge holder. So such a thing after 120 days should now be made known in the financial statement itself. Disclose usage of borrowings from banks, financial institution not used for specific purpose and willful defaulters. Compliance with the number of layers of companies. So audit report, SBN deleted. I mean SBM this year and last year itself we are deleted anyway. It was applicable only for 16-17. Benami company, giver company, receiver company, through management representation and separately through audit procedures, we have to talk about the conduit lending. Compliance with section 123 on dividends. Audit trail on accounting software, which will, of course, all these changes are not applicable for 2021. For next year, maybe we can revisit. Board also, the board report also, there are certain changes. Application made or proceedings pending with the status under IBC. Difference in valuation done during OTS and while taking the loan from banks or financial institutions with reasons have to be told. That is again from 21-22. A comprehensive audit report. Let me probably stop here. Comprehensive, because there may be some questions. A comprehensive snapshot of an auditor's report format as per SA 700, 705, 706, including the new amendments. I have tried to cover it in one form, one page. The report, in fact, there will be two reports actually, report on financial statement, report on other legal and regulatory requirements. Although we know that there are two reports, maybe somehow we would not have been conscious of this particular presentation, but I consciously put it under two headings. In the report of financial statement is where you bring in the opinion on the financial statement. It could be a qualified opinion, adverse opinion, or a disclaimer of an opinion, the heading itself, depending on what type of report you want to give. Then point number 2, basis of opinion. If it is a clean report, the basis of opinion will have to be given, and under that paragraph you say that I have audited as per the standards on auditing. Then I refer to the auditor's responsibility paragraph. Then I refer to the auditor's independence, ethical requirements, code of ethics compliance, sufficient appropriate audit evidence obtained. All these things form the basis of my opinion. And if it is a basis of qualified opinion, apart from this, I also give my qualification. and for basis for adverse opinion and basis of disclaimer of an opinion, I give the things accordingly. Then material uncertainty relating to going concern. This please understand, if needed only I give this particular paragraph. We have discussed this enough number of times today. Emphasis of matter will follow next. To differentiate from key audit matter, emphasis of matter subsequent event type heading can be used. Key audit matter may be placed before EOM if key audit matter is very important. I mean, that is how they have given an option. Key audit matter only for listed entities. Other information other than the financial statements and auditor's report, they are thereon. Then we have the management responsibility, typical, you can copy and paste. Auditor's report responsibility plus annexure A, description assertions. Now point number 7 and 8 are all mostly taken, can be taken from the illustration, but A, B, C, all those things, unless it is a qualified opinion, please customize it accordingly. Then other matter paragraph we have discussed, that comes as 9th point. You may not have all the 9 points in every company, because if material uncertainty paragraph is not there or EOM paragraph is not there, accordingly the numbers will change. Then report on other legal and regulatory requirements. CARO report under section 133(11), wherever it is applicable. Then 143(3) auditors report including IFC report, including IFC report. So 143(3), I have to say that in agreement with the books of accounts, so many things, information, etc., taken, branches, etc. I'll have to talk about that. Then other matter to be included in the audit reports as per rule 11. For the moment, there are only A, B, C items. D anyway we have dropped. E, F, and G will come from next year. So pending litigation impacting its financial position, providing for material foreseeable losses on long-term contracts, delay in transferring amounts to IEPF. So Companies Amendment Act and changes in CSR, we have already seen. These Amendments Act are not very important for us as auditors. The one very important, we have already seen changes in CSR. Points to be noted about CSR is a CSR committee not required if CSR spending is less than 50 lakhs. Functions of such committee shall be discharged by the board of directors itself. 22nd January, these changes happened. Set off of excess amount spent on CSR in a particular year, financial year, towards such obligation in the subsequent year is possible. Suppose against 1 crore liability, I have spent 1 crore 50 lakhs. That 50 lakhs I can take as though I have spent it for next year. But how many more years means I can consider it only for three immediately succeeding financial years. That is what is told in the rules. Penalty for non-compliances are very heavy. 135.5 and 135.6 we have already discussed. Penalty is very high. Unspent amount, I think Jaman also talked about it. If there are any against 1 crore, I have spent only 70 lakhs. I have to make a provision for 30 lakhs unspent. So earlier it was spend or explain. Now spend or make a provision for unspent and comply with the 135.5 and 6. MCA has further clarified on CSR spending. PMR CARES fund transfer is also now included under Schedule 7. COVID-19 related R&D expenditure eligible for CSR subject to certain conditions. Then funds spent for CSR activities related to COVID-19 shall be covered under the head promotion of healthcare, including preventive healthcare and sanitation. Then funds spent for undertaking awareness program, campaign or public outreach campaigns on COVID-19 vaccine is also considered a CSR activity. Funds spent for setting up makeshift. Please mute. Okay. And temporary COVID care facility is also considered as CSR spending. So these are other aspects of CSR not required for audit, but what the company has to do. Taxation, of course, it is not allowed for tax. CSR Amendment Act, very importantly, 129A will now tell which class companies should come out with the quarterly audited financial statements yet to be notified. So these are not very important. Couple of things for companies is board meetings through video conferencing now can happen forever. Earlier there were certain 5 points on which you could not have done a video conferencing board meeting. You have to do a physical meeting. Now they said, in fact, 15th June there was a notification saying that I think it was rule 4 of the company's meeting rules. So that has got completely abolished. So all the meetings can be done by the board through a board video conferencing, but you have to record properly. There are certain conditions which have to be complied. EGM up to 31st December can be done through VC. AGM for 20 and 21 can be done through VC only. Then CARO 2020, we have seen the deferment. gap between two board meetings, nothing to do with the auditors, so I will skip these points. ICAI announcements on accounting, communication with the retiring auditor a must. Feedback to credit rating agencies about the audit client can be done only with the permission of the client, otherwise you cannot do. CA may use DSC for signing the UDIN. I mean, UDIN all of us know. So there are certain advisories given by the Institute for COVID-19 audit. 27 March 2020, impact of COVID-19 on audit of financial statements for the financial year ending. How do we consider the impact of COVID-19? April 20, there were COVID-19 FAQs on Ind AS. May 20, there was advisory for statutory bank branch auditors. 10th May, going concern, how it is to be ascertained. 13th May, physical inventory verification, wherever it could not be done, guidance has been given. So what they have done is, where attendance is impracticable, alternative audit procedures has to be carried out, else issue a modified report. Consider reporting under other matter paragraph as appropriate if physical count is done by any other chartered accountant or local CA. May 2020, auditors report key audit consideration amid COVID-19 and subsequent events. There has been certain guidance by the institute. Other aspects affecting accounts and audit. Only thing I want to talk about MSMEs is, how do you report for MSME purposes? Since the definition has got changed from 1720, for 2021 there may be a lot of companies which can come under MSMEs. So you will have to ensure that fresh letters are issued to all the vendors to say whether they are MSMEs. Normally this could go up, so please ensure that that is taken care of. Total outstanding dues of MSMEs and total outstanding dues to creditors other than MSMEs. So you will also have to take care of RBI reliefs. How do you talk about the deferment of borrowings has been permitted by the Reserve Bank of India? How do you deal with that? That becomes a separate thing. So audit documentation can be kept in electronic mode. Audit evidence may be difficult to be collected during, because they could all be in electronic mode. Please have a proper data retention. External confirmations. Don't rush. Can we afford to rush audit during the COVID? And I always keep telling this, although you may, I mean, all of us are in the same position, but in hindsight, after 4 or 5 years, when some disciplinary action is taken up, it could be taken up against one person and not against all the person. You cannot say all of them had done like that. Like in the case of demonetization. In the case of demonetization, a lot of people took up the banned currency because everybody else was taking, and then only one of them got caught and he has to face the music. So COVID-19 challenges, implication on audit report. Report new CAM. Material uncertainty in relating to going concern can be an issue. Somebody asked this question, EOM paragraph, significant uncertainty arising from the outbreak. Qualification or adverse opinion in respect of inadequate disclosures in the financial statement. Internal financial controls could be an additional risk area because of the lot of server issues or work from home environment. There could be control issues. Reserve Bank of India's notice given to an auditor for not complying with that 45(1)(a) requirement. So please take care of this. External bodies are also going to watch us. Chartered accountants, please understand that we all, I used to tell this for some chartered accountants who had Hyderabad-based chairman of Hyderabad branch last year was Pankaj Trivedi. Trivedi means one who specializes in 3 Vedas. For us, the 3 Vedas are accounting standards, standards on auditing, and code of ethics. So please ensure that these 3 Vedas, which are required by the chartered accountant, has to be complied, so that all of us could become Trivedis. So that is the most important. And for us, of course, there could be a Chaturveda in the form of Companies Act itself. So be the Chaturvedi. So I have to close it. It's about 8 o'clock. I am proud to be a chartered accountant. Wishing all of you at least 7 days late happy Chartered Accountants Day. And closing my session by talking about Mahatma Gandhi's statement, one must hold his talent in trust for the society. So we are all, as auditors, trustees on behalf of the stakeholders. Let us live up to that particular 2 alphabets of trust. Thank you so much.
Thank you.
Yes, please. Any questions? I am prepared to take.
Selva, we have questions lined up.
We have something around 15 questions.
Is clause 44 form 3CD except? Okay, I think tax audit question is the clause 44 of form 3CD exempt as in the earlier years, or has it been made?
2 clauses, one on GAR and one on GST reconciliations. have been kept under abeyance for this year also.
If a company owns a theater which is not working on account of COVID-19 policies and government order, not opened, is a separate segment what to be
Yeah,
reported?
I will read it.
Or-
I think there is some problem with it. If a company owns a theater which is on not working on account of COVID-19 policies and as per the government order not opened, where to report? This is a separate segment what to be reported. So first of all, we have to worry about the going concern aspect. If the going concern is intact, you can put a paragraph just for your for everybody else to know. And if there is no other aspect, there is no reporting. The very fact that there is a loss in the company goes to show that there is the sector is otherwise affected. To add what was mentioned, auditor should not give compilation report and then also conduct the audit. To add what was mentioned, auditor should not give compilation report and then also to conduct the audit. I don't know, this is a question or an answer, I don't know. Okay, next.
No, sir, I think the point is like, see, for example, the audit may be done in let's say non-corporate entities by September, or then after probably April or so for the bank renewal, they would ask for a compilation report. So is it possible to issue a compilation report and then as the auditor of the company, 3-4 months later, can you issue an auditor's report as well?
That is the right thing to do. That is the right thing to do. You should give a compilation report, and in the interim you give a compilation report, and thereafter you give a regular report. As you rightly said, compilation report very clearly says this is not, I have not conducted the audit.
Audit, yeah. If I am audible, since your throat needs a break, I will raise a questions. Projections for future years are required by banks and financial institutions. Can it be signed by CA with the UDIN?
Question already answered. Follow 4410.
Yeah. Projections say 3400 only. Is it necessary to give independent audit report along with tax audit for non-corporates liable for tax audit?
No, the answer is no. You don't have to give unless somebody wants it. They can use that audit report itself for the general purposes also. But ensure that the wordings as told in the guidance note is tucked in clause 3 or clause, because it might be clause 5 because it is for a non-company for using form 3CB. Clause 5 may you put in all the standards on auditing clauses as told in the guidance note.
During floods, a lot of vehicles were damaged and sunk in water. Please suggest treatment in accounts.
Impairment. Follow accounting standard 28.
Okay. With new labor code, gratuity is payable from year 1. Is my understanding correct?
The understanding is correct, but for the moment, it is still not put into vogue. So let us follow the law which is in vogue.
That's the next question which is in vogue. Like 24th March 2021 Schedule 3 amendments, is it final or should we wait for the gazetted copy?
It is already gazetted. It's already gazetted, but it is applicable for 21-22 financial year.
Auditor is accepted on 29/2020 by a trust, and he accepts the same later on 31/1/21. Auditor seeks to resign from audit engagement without any genuine reason cause. Can he resign or is liable for any fine or penalty? It's a trust, sir. It's a trust. So Companies Act, no.
Yeah, I mean, Companies Act will definitely not be applicable. But then even for a trust, I think there looks to be a breach of trust between the auditor and the auditee. That is the answer that I can talk. But I think the auditor has to be very responsible in this situation. I would not answer this question. I would generally answer that the auditor has to be very responsible. He has to complete it, or in case there is a genuine reason, he has to quote that reason and then only he has to resign. And the reason cannot be in view of my preoccupation, I am resigning. Let us make it very clear. Please don't give that as an answer. If you say that in view of my preoccupation, I have resigned, and very next day you filed an ADT 1 for other companies, then that doesn't go in sync. So that could also be a matter for further investigation. So give the proper reason. If they say that the management wanted me to do something and I was not able to do, I mean, I would say that there was difference of opinion with the management on a particular treatment. Hence, I have preferred to resign rather than fall in line. Give an exact reason so that the next auditor comes to know the reality. I mean, they have actually, let me tell you that auditors have resigned and subsequent auditors who have come in have done the audit in very short time. That itself is a matter of investigation. So please keep tab of that.
When a loan is sanctioned with the joint name of director and company as co-applicant, is it an exempted deposit?
when a loan is sanctioned in the joint name of a director and a company. So yeah, I think it's a very interesting question, but the primary applicant will be the company, because if the primary applicant is the company, then I would still consider it as an exempt company, because it cannot be taken as a director, because in that context the director has brought in the money into the company by virtue of borrowing itself, which is very apparent. So as long as the primary applicant is the company, it can be considered as an exempt deposit.
Customer advances where the business cycle is more than 12 months, like in defense, is it exempted under 73?
Yes, the answer is yes, because it comes as capital projects. Under capital project, it is considered as more than 6. Very interestingly, Jamanji, we have to see from whose point of view it is capital, because from the seller's point of view, it is not capital. From the receiver's point of view, it is capital. Since it is not told from whose point of view, I would presume that any one person's point of view, if it is capital asset, it is considered as exempt. That is the argument that we are putting across.
Whether free reserves include OCI, also where fair values are considered when the company is having investments in listed company equities.
In my opinion, free reserves does not include other comprehensive.
Free reserves have been defined as such reserves which, as per latest audited balance sheet of the company, are available for distribution as dividend. Probably in response to you are saying that surplus is not part of reserve.
Very interesting, Pandaraj sir. I mean, reserves and surplus are two different things. Normally, we think that free reserves includes accumulated profit, but accumulated profits are different. How we have to get into is declaration of dividend out of free reserves. Declaration of dividend out of reserves. The question is, can you declare dividends out of accumulated profits without complying with the declaration of dividends out of reserves? Means the answer is yes. You can declare dividends out of current year profit or accumulated profits or out of free reserves. The compliance with the rule on declaration of dividends out of reserves applies only to the third category and not to the first two categories. Very interesting.
If the company can show the CSR provision in the statement of P&L as a separate expense head under other expenses, okay, should the company show CSR provision in the statement of P&L as a separate
representation? In fact, there is no requirement under Schedule 3 to show it separately, but then now the new Schedule 3 wants you to anyway disclose lot of information. I would always say, if there is a CSR expenditure, please take what should I say, a credit of showing that as a separate line item. Why companies probably do not show is they would like to hide it and claim it for income tax purpose. Please don't do that. Show it as a separate line item, disallow it for income tax purposes.
Sir, we are hitting the 45th question. You have answered everything so very well. Whether any provision required in financial statements for unspent amount of CSR or just a transfer of amount is enough?
I think I answered this question. For if you have spent 70 lakhs as against 1 crore, 30 lakhs ke liye, you have to make a provision. That is the dictation from the institute, and that is rightfully so.
A hit in the P&L without a tax benefit.
A hit in the tax, yeah. You cannot have every expenditure only for tax benefit. Yeah, larger benefit.
Banks insist on auditor's signature with the seal on ITR, computation of income, final unaudited accounts, also provisional final accounts. What to do, sir? It causes embarrassment for the client.
Ask them to give it in writing and send it to Reserve Bank of India and to
RBI.
The what is that called? Banker IBA. So that they will take them to task.
If the company does not spend before 31/3 but spends before 39, is it sufficient compliance? What happens on the unspent amount of previous years? Should provision be made on 31/3/21? This is again on 135 CSR. And should these old unspent amount also be transferred to specified funds?
No, the answer is only for those funds which are for the financial year 2021, because from 22nd January this provision came in. So therefore, for the whole of the year 2021, this will be applicable. For 1920, if there is any unspent amount, you don't have to transfer it. So that is the opinion that has come out legally, and I agree with that particular opinion. You don't have to. Anyway, you would not have made.
Yeah, please.
Anyway, you please have made a provision. If there is any provision done, you may reverse it. That is also possible.
But that answers the next question.
What he said, sir, what he said, let me just clarify. On 31/3, you did not spend, but you spent it on 39. Then you may say that it is towards an ongoing project, and towards an ongoing project you are required to put it on 30th April. That is the catch there. You did not put it on 30th April into the bank account, but this year I am sure because of the lockdown, the government will take it on a very lenient. In fact, there was a lot of representation which has gone to MCA. We are waiting for clarification to say that if you are not able to put it separately into the bank account on 30th/4, it is still okay, because it should be treated like our 40A1A expenditure or a 43B expenditure. That is a semblance which we are given, and given a representation. Hopefully
that answers the last question, 47th question also, whether CSR obligation prior to 1/4/2020 also needs to be transferred to specified fund, or is it sufficient to disclose in the director's report? That has been answered. Great, sir. One wonderful session, a terrific discourse of 8:15, so 3 hours, and salute your stamina, the flow with which you handled everything. The provisions of the Companies Act, then the audit provisions, Schedule 3, accounting standards, auditing standards, CSR, OECD, and everything in such a, I mean, not a very short span of time, but then this is the minimum that was required, and only you can do this in such a short span of time. And I was throughout there. Of course, I had switched off the video for a few minutes in between. So I think the crowd is, the participants are still with us. The questions in the chat box suggested that they stayed relevant and they were glued to your presentation. Thank you once again on behalf of SIRC. There's a formal vote of thanks coming from your own guru. So I think I should not get into that. And happy that Addisimula Rao sir has come back with a video, because I really wanted to see after a very long time how many all we have traveled together. I was his vice chairman, and traveled together, and many of the times we never used to take 2 rooms. We used to share the room, stay, have food together. It was a great experience. So nice to see you back. So hope you are all doing well. So wonderful presentation, and a great roundup with lot of quotes from Mahatma Gandhi, and the three Vedas, which are very, very important. Hope the membership would live up to I would say, the challenges posed by the regulatory environment as well as the legal environment, which has been so brilliantly, so eloquently highlighted by you. Not unexpected of Gururaj Acharya sir, because I said Guru, Raja and Acharya. It is now over to his own guru for the roundup and the word of thanks. I think Revati ma'am would have hopped back home. She was traveling in between. Sundarajan sir also, thank you for staying with us. Sir, ma'am is still there. Okay, she has reached home, not traveling anymore. Right.
Thank you.
Back to you, sir. Thank you so much for the opportunity.
Yes. It's a great program. I think most of the words which I would have used, Jaman has used, and any adjective would be less to explain the presentation, the way he has presented. In my opinion, the same presentation he has done in Bangalore branch for 900 plus, which made me prompted me to speak to the chairman and request him to have this session here. And his strength is doubled compared to what it was at Bangalore. So hats off to your presentation, Mr. Gururaj, and we are all proud of you. And I am doubly proud that you are from my place, in a small place, and normally there will be what's called inferiority complexion for people who have schooled themselves in small places like Bellary. And in some way, I have proved many members wrong, but you have proved most people wrong. So we sail in the same boat by making Bellary also proud. So I am very, very happy on this occasion. And as I proved myself to be right, that I have started learning from you. And the way you present, I wish the members to observe one thing in his presentation. He prepares his PPT so meticulously. You would have observed so many colors, so many sizes. Deposits, you could have seen green color. That green means just like this traffic signal colors, he uses those colors. For blue, you only has to explain. Yellow, red, and green are just like traffic signal lights. And that is the meticulous observation that he does in doing those presentations. Whenever I drop in its office at Bangalore, I would be seeing some presentation or the other. I would be asking what is this importance of this color, size, font, everything. So everything has some meaning. So that is the amount of efforts he does. Number one. Number two, and is connectivity, that is comprehensiveness in connecting one law to the other. As you rightly pointed out, legalities and professionalism. This bridging these things is not at all an easy thing. And above all, going with that flow and arresting the audience for consistently 3 hours. We have all left our chairs for at least 2-3 minutes or 5 minutes, but he did not move out of his chair for the whole 3 hours without break. He has done that. Hats off to his mental strength and physical strength, and also strength of your heart, or the bigness of your heart to spend so much of time and energy, your passion to give the inputs to our members. And definitely by attending this one, every member would get at least 10 to 15% additional strength or confidence to face the audits under these difficult times. So hats off to you, Gururaj. If at all I tell much more than this, it will be again a relative party. So thank you very much on behalf of SIRC, and very happy to see our sound man, Adusmalli Garu. He was popularly called sound man because in RC always his sound was very high, and with me and Joman have that experience. I used to call always, he has only kept his name.
Sound was there only for 1 minute. After that, you say, no, what I'm saying is, say, who told you and all that? He'll raise his voice.
Yes,
who told you that? He's such a nice person at heart.
Great. Happy to see Adusmalli Garu after so many days, and happy that very, very great job done by German also. You have sailed shoulder to shoulder. You have moved with Mr. Gururaj in these subject matters also, keeping the things very live. And as you were using your quote, I wish to use your quote also. There should be more of light than heat. So today there is more of light than heat. We used to, for the benefit of Gururaj and other members, he used to make this statement in the regional councils. Whenever there is a sound man making some heat, that is Adusmalli Garu, he used to tell, let there be light, let there be light, not heat. So that's the way these two people have done a great job as chairman in the SIRC. We would definitely cherish your days and try to emulate your leadership qualities. And I also will fail in my duty if I don't thank Revati Madam and Sundarajan, both being localites. They, despite their other commitments, in the last moment we had to rope them in to make it a very team effort. It is a team effort for organizing for a single man, that is Gururaj. So he was the engine, and we all tried ourselves to be bogies, and the real passengers are our audience. They are the people who have benefited to the engine of Gururaj Acharya. I thank each one of you, the delegates, for your participation. Your participation is the real strength or booster to our what's called conducting consistently so many programs. I keep telling my chairman why we should have 5-6 programs a week, but despite that we are getting 700, 800, 900 people. Now I have analyzed that the veracity of the subjects that we are conducting, making the audience to keep the same strength. Every time minimum 500 members are attending. Need not be the same people, because the specialization is need of the hour. So there are at least 30 to 35 new professional opportunities we have tried to identify, and require members to enlighten themselves on those fields to make an opportunity of additional source of earning for them in the profession. So I think we deserve that the members' support definitely is good, and we are not wrong in conducting 5 programs in 1 week or 6 programs in 1 week, considering the strength, the attendance that is there. So hats off to your participation and your support, all the members. I thank you on behalf of SIRC. I thank each one of you for making this day great. Once again, hats off to you, Mr. Gururaj, and we call it a day for this day. And good night and happy day at all. Thank you very much.
Thank you to actually our friend Mr. Jalpati also, chairman, for arranging a good program. And as usual, Gururaj Acharya garu has done excellent presentation. Hats up to you, sir. Thank you. Thank you all.
Wonderful, wonderful. Good that you remembered the chairman. Jalapati is, I think, this only meeting he has missed.
Yeah,
The message that-
Jalpati, I should thank Jalpati also for accommodating this program, and also SIRC's back office, and especially Selva for giving this technical support. Sorry
Seamless
for my
technical support.
interpretation.
Because the chairman was not there, he ensured that 2 past chairmen were there.
2 part chairman, 3 regional council members.
3
That's
future
great.
chairmen.
2 past chairman, 3 future chairman, you can say.
Thank you.
Chairperson, chairman also.
Thank you.
Gururaj, thank you so much. It was really nice. Very, very informative learning experience for me.
Because I was expecting some junior to join, but then when you came, I think it was a double advantage for me. Taking really
Thank you. I wanted to say, learn more with you. Thank you so much. Bye.
Thank you.
Thank you very much.
Thank you all. Thank you all. Thank you all.